Hey folks, good evening to you all and welcome to another Money Space with me, Kalu Aja. Of course, on this space, we're here every Sunday, 7 p.m., 7:30 p.m., sorry about that, West African time. And of course, we're talking money, the economy, and finance, and the whole idea is to make ourselves better investors. That's why we're here. So guys, today we've got the topic of debt. And it just goes with what we've been doing all, to we say, from 2024, December till this year. We're talking about the major themes in financial planning, right? We set up with the income and expenses. Then we went into net worth, which is your assets and your liabilities. And then, of course, we talked about investing, how to do asset allocation. We talked about inflation. We brought in two folks that talked about how to even invest in 2025. And we felt it was also expedient this week to then talk about debt, because debt gets a bad rap in investing. Lots of people say, I don't want to borrow, or lots of folks want to borrow but don't know how. Debt is not good or bad. Nothing in finance is good or bad. It's just how you use it. So let's do a space, as it were, on debt, borrowing, what is good debt, what is bad debt, and all that kind of stuff, right? So that we can learn and hopefully we can use that to advantage. Of course, debt is going to be from mortgages all the way to credit cards. And guys, it's going to be very interactive space. I can't really talk a lot about debt. If you guys ask those questions, it will be fantastic so that we can all learn together. But let me just give you a primer, right? Let me just start with good debt, bad debt. Good debt is debt. First of all, what is debt? Debt is front-loaded consumption, right? Front-loaded consumption. When you borrow, what you're doing essentially is that you are borrowing against future income. So you're going to make money tomorrow, but you want to spend money today. So you borrow against that future income, and then that becomes front-loaded consumption because you are borrowing to consume or to invest. So you are front-loading that investment or that consumption, which means that you have created that hole in the future, right? There's a hole in future you have created. So you have to cover that hole up. So the whole concept of debt is that when you borrow today, you want to make money to the next day to pay off in the coming years. That's the whole issue of debt. If you are borrowing because there's an unexpected expense, the same thing. You are front-loading that consumption today. You are going to create a hole tomorrow, which you need to cover up. Which means, right, that debt can be good and debt can be bad if we can generate revenues today to cover up the expenses hole we have created into the future. So what's a good debt? A good debt is going to be like a mortgage, right? Let's say you have a 30-year mortgage and then you are borrowing to buy that house. The issue is when you borrow, the house or the asset is also appreciated in value, but your debt or the interest rate that you're paying is more or less fixed. It could be fixed for 30 years. It could be fixed for even 10 years. But when you compare the debt, the rise in the debt, and then the rise in the asset value, you would see that the asset value, which is the house, in most instances would keep pace with the debt or would even grow faster than the debt. So the revenues that you are getting or the benefits you are getting tend to be better or to grow more or to be, give you a better net worth than the cost of the debt itself. So that's good debt. Number one, the cost of this debt is not larger than the revenues or the asset growth of what you have bought. So if it's a good debt, it means that what you are paying is less than what you are getting. With a mortgage, you are paying a fixed cost, but the asset appreciation is basically going on, and it's also tagging on to inflation. So take Nigeria, for instance. If you bought a house in, say, Aba or Lekki or Kaduna, right, the house value would appreciate with inflation. But the loan that you've taken to buy that house is usually fixed. You usually get a fixed deposit a fixed credit from the bank to buy that loan. So you see that balance that you get. You are every month that goes forward, your interest rate is bending down, but your asset value is going up. That's good debt. So what's bad debt? Bad debt is, of course, the debt where the cost of the interest is higher or is more costly than the revenues or the enjoyment you're going to get from that activity. So if you say you use your credit card and you go on a vacation, right, to say Dubai, you're not making any revenues. Remember, it's just vacation holiday. It's good for your soul, but you're not making any revenues, right? So you're putting points, or should we say cash or balance on that credit card. So the rate of growth of that credit card is going to be higher than the rate of growth that you're going to get from the asset appreciation if there was no asset bought anyway. So you could argue that that's bad debt because you have to pay that consumption over time with interest, and there is no revenue that has come through to help you to pay that. So that's good debt and bad debt in simple forms. If you borrow to buy something or to invest in something that can pay you back, that's good debt. If you are borrowing to buy or invest in something that's not going to pay you back any revenues, that's of course bad debt. And like we said, it's a lot we're going to talk about. Really, I don't want to take your time. So if you folks have got questions, I see the DMs, people are already active. Let's ask, right? Let's make it a very interactive session. Let me get those questions, and then we can take them. I have a long list here. If you look at it, what we posted up here. FICO. How can you get a good credit score, right? How can we've done good debt, bad debt, mortgages, credit cards. How is the best way to use them? I can go on and on and on, but I don't want to. So I prefer to basically take my answers down to what you guys really want to know about so that I can answer. And let me just jump real quick on the DMs. Is our credit, it's a great question from Shay, Shay010, Shay. Yeah, Shay's asking, are credit cards, should I get a credit card? Are they good? What is the pros and cons of getting credit cards? Great question. Now, I call credit cards can be good and credit cards can be bad, but you put to be very, very careful about credit cards. When you go to the West, it's a credit society, which means that everything is on credit. You can pay for really anything on credit, and you are encouraged, or should we even say mandated, to get credit in the West because you have a credit score. And if you want to buy a house or you want to buy a car, unless you have the cash in hand, you've got to go borrow. And then if you want to go borrow, they look at your credit score. So the point is this: even if you have your own cash, even if you never borrow, you are doing all good and all that. If you don't have a good credit score, it counts against you. So let's say you don't borrow, you've been kept good balance sheet, and all that, but you want to buy a house, right? They're going to pull your credit. And when they pull your credit, if you have no credit score, you're going to pay higher interest rate than someone that just has maybe average credit. So it's always advisable to have credit. The problem is you can have credit without paying anything. You don't have to pay interest to have credit. So let's come back to credit card, Shay. If I want to get a credit card in the West, I will get a credit card that has points. When I mean points, either when you use the card, you get a cashback reward, or you get points, or whatever is going to give me. I want to get a card that has got a reward. That's number one. Then number two, how do I want to use my credit card? I want to use my credit card without paying interest. The way all credit cards work is this. If you swipe the card, say on the 1st, you have to pay within the cycle date or the calendar date or whatever the card company tells you. If it's 20 days or 30 days, if you pay the balance within that period, you pay absolutely no interest. So what do I pay with my debit card? I pay with my debit card, say I pay my groceries or I buy gas with my credit card, right? My debit card, right? Instead of doing that with my debit card, I use my credit card. I pay for those same groceries that I've paid for with my credit card, but now I'm getting the points. So I pay for gas on the 1st, I pay for gas on the 7th, I pay for gas on the 21st. So I've paid for gas 3 times, right? But what do? I immediately, before the month is over, I clean up my credit card expenses. So I pay 0%. It's like having a 30-day no interest loan. I use the card, I pay off. The credit card gives me a reward. It can be cash, it can be points, it can be whatever the card says it is. But I also increase my credit scoring because every time I swipe my card, I've taken a loan. When I pay back, I've paid back the loan. So of course my credit score goes up. for doing nothing. I'm doing the exact same thing that I use with my debit card. I do it on my credit card, right? So that's the good side of using a credit card. You can use a credit card to increase your credit scoring, number one. And of course, you can use a credit card at no cost to you. And of course, again, the credit card can work to give you rewards. If you get a credit card that pays you airline points, for instance, and you use that credit card all through the year to buy just gas and groceries, you might be paying for your trip back to Nigeria, right? You can use those points and then get a ticket that will bring you back to Nigeria every year. So you've got to plan it out and choose the right card. Credit cards are not good or bad. It's how you use it. What you don't want to do, Sheyi, is to use a credit card to go shopping, right? If you go shopping and you load up the credit card, once you use your card more than 30%, it counts against you. So let's say your card is $1,000. Once you carry a balance, not when you spend, you can spend $1,000 and pay back $1,000, no problem. But once you carry over more than $300 or 30% into the next month, it starts to count against you. Credit cards have a limit of 30% before it counts against you. So what I mean, to carry it over into the next month, that's going to cost you about 30 points on your, if you use that as a percentage out of how you get your score. If you want to have a good score, number one, you pay on time. Number two, you don't carry over more than 30%. If you just do these two alone, you've got 65% of the points that count towards your credit score and your FICO score. So I hope that helps you, right? I would say, number one, yes, take the advantage. It doesn't matter what credit card you get one. If the bank won't give you a credit card because you don't have a credit score, go try and see what's called a secured credit card. Secured credit card. What that means is that you're going to go to the bank or the credit union. You're going to give them your you give them cash, and the bank will then give you that credit card. You give them cash, they give you a credit card. Then use that credit card responsibly. Like I said, get one that has points, right? Or get one that pays you cash back, put the balance on it, pay the balance off, don't carry any balance into the next month. That way your card is 0%, but you are getting the cash for free. Yeah, hope I helped there. Thank you, Sheyi. Second point, what's FICO? Yeah, FICO is just your credit scoring. FICO is the name of a company, Fair Isaacs Corporation. FICO simply is the company or the preeminent company that tracks your credit scoring. In America, there are about 4 of them. I just know 3 offhand. I know TransUnion, I know Experian, I know Expedient. So those 3 guys track your credit scoring. What that means is every time you spend money or you take a loan, if you take a loan from a bank with your social security, anytime you take a loan, those guys basically will send a report. The bank sends a report to the credit bureau. So once you go to a bank or credit union or to anyone that uses your social security to give you a loan, you are creating a copy or a record that the bank or the lending institution will send to the credit scoring bureau. So what you see is that over time, they build up your credit history, who you are borrowing from, who you are paying back to. So other lenders use that credit scoring, your FICO as it were, or just a name for it, to determine if you're a good lender or if you're a bad lender. In simple terms, if you borrow and you pay back on time, then you're a good lender. What's the implication? Your credit cost goes down because your credit scoring goes up. So the higher your credit scoring, the lower your cost of borrowing. Guys, don't sleep on this. If you want to buy a house in the West and you have a high credit score, that extra 1% that your house gives you, that extra 1% that you get, right, because you have a good credit score, can translate to anywhere from $10,000 to $30,000 over those 30 years. So it's very, very important that you have a good credit score. And you don't wait and say till I get a job. Once you get to the country, like I said, if you don't have a job and all that, get a secured credit card. It's good to get it on your social. I don't advise you getting it without a social so that it tracks, over time. Another thing you can do is if you're married, or you can put yourself on your wife's card, on your husband's card, on your partner's card, so that you'll ask the bank, if I put myself on this card, will I also get the points or the credit scoring? Will it also show up on my score? Some banks don't do that. They just give you a card that you can use. Some banks will do that. They'll give you a card that you can use and the points come to you. So be very clear. Ask them. If they say no, there's no point getting it. If they say yes, do get it. So FICO is very important. FICO is one of the most important things or numbers you can get in America after your social security. So you want to make sure that you're getting a good FICO there. All right, great. So lots of great questions here, guys. I'm just trying to read through and just pick the ones that are a bit unique. Abdurrahim is asking, what sort of investment should we avoid making with the debt or borrowed funds? Great question, Abdurrahim. So avoid spending or using your credit card to invest in any project that has a lower return on investment than the APR of the card. So let me explain it this way. The APR means the interest rate the card will charge you, right? If the card is charging you 20% interest rate, then of course you should not use your card to do anything that will charge you less than 20%. That's number one. And Seka, please, I'm going to mute you and Seka, you speak once there. That's number one. Number two, a credit card should not be used for investing. So Abdurrahman, you don't want to use your credit card to invest. You don't want to use your credit card to go buy stocks and shares. Why? Because like I said, your credit card is 30 days, or based on what the card company tells you, is 30 days interest free. So if you have any transaction that's going to make you a profit, that's good. But that profit must be closed out within those 30 days or whatever days your credit card company gives you. So the credit card company says you're going to pay back in 30 days, no interest free. Of course, when you then borrow to invest, you should be able to clean up that transaction within 30 days so you make a higher return on investment. If you borrow and you do a good transaction that is going to pay you in 60 days, of course, you're going to pay the credit card company back with interest for 2 months. So it doesn't make any sense. So number one, the tenure, Abdurrahman, is very, very important. The tenure of the investment, it should be lower than 30 days, number one. Number two, I don't advise you to do any investment because you're not sure of that tenure. And like I said, you use the credit card to build your credit score up and to get points. Credit cards are very dangerous. They have the highest interest rate and highest APRs that you pay. 20% is average. You pay 25, 29. So they are very expensive, but you can use them to your advantage. So try not to use your credit cards to do investing. Use your credit cards to get the points and to increase your score. And Sekan, how you doing? You've got the floor now, sir. Go ahead. And Sekan. All right. So before Sekan gets ready, So just wanted to clarify on the mortgage example you gave. This is from Laurie. Laurie wants me to clarify on the mortgage example I gave earlier. Yes. So if you take a loan to buy a house, right? That's usually looked at as a good investment, good debt. Okay, I see your question. So let me clarify, right? So you're asking if all mortgages are good investments. Of course not. Number one, the rule of mortgages say location, 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 which means that when you want to buy a house, you want to look at the location you're buying that house, correct? So let's say all things being equal, you are paying rent today. You are paying rent today, which means that you want to, whatever happens, you are going to pay rent. So it's either you pay rent or you pay mortgage, but you are still going to pay something from your account to live somewhere. Now, which would you prefer, to pay rent or to pay mortgage? Mortgage is always better. Why? Because with a mortgage, you are getting equity. What is equity? In the West, the way they structure their loans is that when you pay 5% for a house, you own the house. So if a house is worth 100,000 naira or dollars, and I pay $10,000 to the bank, I own the house. I am paying my mortgage. That's a separate matter. But if the house appreciates from 100,000 to 200,000, that 100,000 is my own. It's not owned by the bank. It's owned by me. I can use that appreciation and take a loan and use the money to do what I like. I still pay my mortgage, but it's owned by me. But that's equity. So when you buy a home, you are giving yourself access to equity. So in terms of that alone, even if you're going to pay the same cost as for your rent and for your mortgage, it's always should we say, better to own a mortgage, because you're still going to pay something, but at least the mortgage gives you equity. So if you are going to do that, you want to have a great credit scoring. To buy a home in America, what do you need? 2 years tax return, credit score of more than 700. Now, the higher your credit score and looking at your debt to income determines the interest rate you will pay to the bank for that mortgage. The difference between paying 4% and 5%, that 1% is almost $30,000 over 30 years. So you want to make sure you are planning to say, I want to get the highest credit score with the lowest loan to value so that I can get a very, 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 very good interest rate on my loan. That's your target. So the mortgage is not all mortgages that you should take a loan for. If I wouldn't take a loan to build a home where I'm not going to live in, if the home is going to be in my village. So if I'm from a small village right in the southeast, I wouldn't take a loan to build that house because I don't live in that house. So there's no advantage for me in terms of the equity, right? But if I'm living in, say, in Aba, I can take a loan to build a house in Aba because I still have to pay rent in Aba. But if I live in my own house in Aba, at least I get the equity. You see the point I'm making? So that equity, don't sleep on that equity. Great. And Stikan, are you ready to speak now on Stikan? Just before I move on. On Stikan? You were first year. Okay. Let's get these. I got real_dim. The real_dim. How you doing, sir? The real.
Yeah. Very good evening from here.
How you doing? Yeah, go ahead.
I'm okay. I'm good. Very good evening, everyone. Thank you very much, sir. I've been following you, and you have imparted a lot to me, basically, when it comes to finance. I'm so happy. God bless you more. I wanted to ask you a question because I have an opportunity. To a place to borrow money with an interest of 1.5%.
I didn't hear that. What percent, please? I didn't hear that. What percent?
1.5.
Okay.
1.5%.
Wow.
1.5% interest, and currently the money is not in naira. It's an African country, but it's more higher than naira. Then, but I wanted to know if it's advisable to invest in naira that can be able to give me a yearly of 21.5% interest with the money. I don't know. I'm a little bit confused on that. So that is my little bit.
That's an interesting question because at 1%, that's a very, very good loan because I'm not sure their inflation rate in that country must be very, very low. So if somebody is giving me a loan at 1%, wow, that looks good on paper. So your question is now, can you borrow at that 1% and invest in naira at 20%? Is that what you're asking?
Exactly, sir.
Okay, let's assume that was possible. Let's assume you take that loan at 1%. Let's assume it's in dollar. Let's just, for argument's sake, it's in dollar. You take that dollar loan at 1%. You come to Nigeria. You invest in it, and I give you 25% in investment. You do that. Now you have 25%. How do you take it back to dollar? Are you going to buy dollar and go back to pay? Because you have to pay them back in dollar, right?
Yes. That is it. Yeah, but I can move in with buying goods to transfer it through goods. Yes, and sell it. Then I can convert it to dollar through goods. Yeah.
So you see, the problem is not the interest rate; is that conversion from naira back to their currency. You are saying you're going to buy goods. What if the ports are bad? What if you buy these goods, they get stuck in the port or they get stolen? So that's the risk. The risk to me is not the interest rate. Based on what you told me, I like the interest rate where you're going to borrow. But is to go from naira back to dollar is my problem. So are there 21% investments in Nigeria? Yes, they are, and they are very, very safe. Is the federal government treasury bills are paying anywhere from 18 to about 21%. But you have to have at least 50 million naira to qualify for that. At least 50 million naira. The savings bonds are paying anywhere from 11% to about 13%. You need just 5,000. So yes, if I borrow at 1%, I don't know what country it is, at 1%, and I bring that money, what you're doing is called a carry trade. So you're asking me about a carry trade. If I carry that money from that country to Nigeria, yes, I get the high investment. My problem is I have to find a way to go from naira back to that currency. If you can find that answer, I would say do it. If you can't find that answer, I'll be careful. Look at Nigeria. Julius Berger is now exporting cashew nuts. This is Julius Berger. So they do contracts in Naira, but they're a German company. Nigeria has no Naira dollars. What they do, they are exporting cashew nuts. This is Julius Berger. Can you do the same thing? It's up to you. But that's my only thing I'll say you should watch out for, right? If you can find a way to go back from Naira to that country, maybe you can say you can find people. It just depends on the exchange differential. That's really the answer. In the past, in Nigeria, we used to have what we call a foreign exchange forward market, which means you could go to that market and buy your dollars for 5 or 4 or 3 years. We don't have it anymore. So I would say the one leg is good. The only part I have issues with is the one that is going to go back. That's what I'll say. Does that answer your question?
Yeah, thank you very much. I have gotten what I heard.
Perfect. Let's get Nsikan. Nsikan, go ahead. You've got the floor.
All right, sir. Thank you so much for this session. I'm actually listening in from the UK. Mm-hmm. I believe you can hear me.
I can very well.
Right. So I'm an international student here doing my MSc. I'd like to know if you would, encourage an international student in the UK to take a credit card.
Yeah, that's what I just said. So let's step back a bit, right? The West is a credit society. So I always advise that when you are in Rome, you do as the Romans do. You get a credit card. But let me caveat. As a student, you don't have that much income. So what I want you to get is to get a credit card that helps your credit score, not a card that you're going to spend it. So I would go to a bank and say, I want to get a credit card, but I want you to have points. Either it has cashback points or it has travel points or whatever reward it is. I want to get a reward, a card that has a reward. If I get that, how do I use that card? I buy groceries. The same thing you would buy with your debit card. Not shopping. When I mean shopping, not going on a shopping spree. But the same items you pay for, your utilities, your gas, your books, the same thing you would have paid with your debit card, use your credit card. Get the points. Then make sure you clean up, i.e. you pay up before the month is over. As long as your balance at the end of the month is zero, the credit card company will not charge you any interest, irrespective of what the interest is charged on the card. So if you do it the way I've explained it, yes, get a credit card in that line. That's the only time I recommend you get a credit card as a student. If you want to get a credit card to spend, the answer is no. They are very, very dangerous. They charge you a very, very high annual percentage rate. So unless you are getting a credit card to get the points and are going to clean up every month, do not get the credit card. Does that answer your question?
Yes, thank you.
Perfect. I have a question here from Joseph on the DM, but let me get Duke to answer because Joseph's question is very interesting. I want to really explore it. Duke of Obudu, you've got the floor.
Yeah. Thank you very much, Kalu.
You're welcome.
I appreciate what you do here. So my question is on the credit card. I understand that what the credit card does because I've been doing a little bit of research on that. But I'm looking at the bad side of credit card. Now, I get to understand that there may be a cap on spending. Like if you get a credit card, the credit card company may be expecting you to spend a particular amount in a month. My question now is, how, if you are not able to spend that particular amount, the credit card company expects you to spend in a particular month, what happens? Is it that your credit score will go negative, or what happens? That is
great question. I don't think credit cards, most credit cards as I know do not require you to spend, that you're not mandated to spend. What most credit cards do that is bad is that they give you an annual cost. So they'll say you have to pay an annual cost for this card, which is why I'm saying you want to shop around. You don't want to get a credit card that has an annual cost, because that annual cost means whether you shop, you don't shop, you're going to pay. So let's assume you get a card that has a 0% annual cost. You don't have to spend. The point is, if you don't spend, your credit score does not go up. You see, they are forcing you to spend because that's how their culture is. So you don't argue. You basically go to Rome and do as the Romans do. So if they are saying you need to have a good credit score to buy a house at a lower point. You follow them. But what you do is that you follow them with sense, right? So what you say is, okay, I'm going to get a credit card for $1,000. Doesn't matter how much the card is. A card of 500 and a card of 10,000 is the same principle. If you get that card, as long as you use the card and pay back on the card, you've got 35 points. So as long as I use the card and I pay back on time, 35 points. As long as I keep less than 30% on that card, meaning that I don't carry more than 30% from the 1 month to the next month, I get 30%. So 35 plus 30, I already have 65 points from just doing these two activities. So pay your card on time. Don't carry more than 30% over from 1 month to the next month. You are already at 65%. Then what are the other points? How long I've got my credit card is 10 points. Which is why, like in Stick and Axe, you want to get your credit card as early as possible because you're going to lose 10 points if you don't get it. What is the other point? The type of credit that you have. So if you just have only credit cards, maybe you don't get enough points. But if you have a credit card and a personal loan, now you get extra points for the type, the spread of credit that you have, right? Then the most dangerous one, Dele, is this. When you have a credit card, please don't apply for a second one, especially if you're like a student or a low-income earner. Every time you apply for credit and the credit card company pulls your credit score, which is called an inquiry, it dips your score. So unless you really want to get a loan, you go to the store. Most stores will tell you, hey, welcome to TJ Maxx, right? Do you want to get a TJ Maxx card? I shouldn't have used their name. Do you want to get a card so that you can get a discount today? If you say yes, you are applying for a credit card. They don't say it that way, but you are applying for a credit card. Every time you apply for a credit card, that's an inquiry. It reduces your score. So you want to be very careful. Once you have one, leave it at one because you want to build up your score. So you get a card with no annual points. You get a card with rewards. Just buy your grocery or your gas. Buy $50 or £50 every week. Pay it off. £50 every week. Pay it off. If you just do this for 1 year, you're going to have the highest credit scoring. It's not hard. You don't have to do anything complicated. Get a card for £500 or $500. Use $50. Use £50. Pay it off. Repeat. Do it every week for at least 8 months. You're going to have the highest credit score. You might not have the highest because you don't have a personal loans, but you get what I mean. You'll be at a very, very high number. Does that work for you, sir?
Yes, thank you. Sorry, just one more.
Sure.
In the case of mortgage, hello? Yeah. The case of mortgage, you talked about, for instance, looking at the age here now, let's say maybe then I move to the West and I want to buy a house and I put in maybe a house of £100,000, maybe $100,000 now, and I put in maybe the period is 30 years, and I am like let me say like 40, and I said I will stop working maybe at the age of 55 or at the age of 50. So is it advisable that you put down a 10% or a 5% and say you want to get a mortgage for the house?
So the reason why you put a down payment has nothing to do with how long you want to stay or how long you don't want to stay. It has to do with your how much interest you want to pay every month from your pocket. So there are two types of mortgage in the West, two types. One is the adjustable rate mortgage, the what we call the ARM, adjustable rate mortgage. That one means that when you buy that house, right, your mortgage can go up or down based on what the central bank's rates goes up and down with, right? The other one is called a fixed rate mortgage, right? That's a normal one where once you buy the house, it's going to be a fixed rate going forward. It doesn't go up or down. Now, your question is this. If you are going to stay for 4 years, 3 years, or you're going to stay less than 5 years, then it may make sense to buy an adjustable rate mortgage if the rates are lower, because you are trying to get that house at the lower cost and you are hoping that the house value goes up so you can get out of the transaction, so you can sell. So you want to keep your interest rates very, very low, get the house, then you are hoping that you want to flip this house in 2-3 years. Then you can flip the house without paying that high interest cost. You see the point I'm making? It's not really has to do with your it has to do with your objective. If you want to buy that house to live in that house, right, and rates are low, always go for the fixed because you are locking the low rate going forward, right? Let's look at today. In America, rates for mortgages are higher than usual. They're about 6, 7, 8%. They are higher than usual. So if I want to buy a mortgage now in America with all the uncertainty, would I buy an adjustable rate mortgage? Maybe not, because I'm not sure what will happen in the future. I want to buy something that I think is low, right? But even if I buy today at 8% and I lock it in, if rates fall down, I can refinance at a lower rate. So I can go from 8% to 6% by refinancing my mortgage. But if I buy an adjustable rate mortgage, I'm saying that the rates can go up, rates can come down. So it's not really, to your question, it doesn't matter. Your down payment has got to do with what you want to achieve with that home. The more you pay a down payment, the less your monthly interest is. In America, we have what we call the insurance. What's the name of this insurance? PMI. PMI is insurance you pay to the lender, not yourself, to the lender. If you pay less than 20% to buy a house, they will charge you PMI. You don't want to pay PMI because it's not your insurance. It's like you're buying insurance for the bank. So if you pay more than 20%, you don't pay PMI. But the question that you want to ask yourself is, okay, if rates are so low, I just pay it together. Why do I have to pay 20% of my money on a house? I have that cash, I can go somewhere else. So what I'm trying to answer is this, Duke. It has to do with the objective. Why you are buying that house will determine if you should pay a high down payment or a low down payment. If you're going to flip that house, you are looking at keeping as much cash as you have with yourself. But if the house you're going to live in for 10 years, pay the PM, pay the 20% and reduce your future interest payments on the house. Does that make sense, Duke?
Yeah.
Yeah. So look at it that way. Adjustable rate is fluctuating, but it's cheaper initially. So you're looking at selling the house quickly. That's your objective, ARM. But if you're looking at living in that house with your kids in school, good school district, pay the thing, reduce your monthly interest rate, and enjoy it. You can always refinance downwards. Doesn't matter, right? So that's how you want to look at it. Yeah? Okay. Joseph, I'm reading your DM. Very, very interesting DM. So Joseph says, let me try to explain to you. Joseph says he has an opportunity for a loan of 20%. So Joseph, our loan is 20%. Rebate of 6%. So meaning you're going to pay about 14%. So it's 14% loan, right? And it's for 1 to 3 years. So we have a 14% loan for 1 to 3 years. The repayment is 3 years. And it's going to cost you 35% of your salary. You didn't tell me, okay, 35% of your salary. Okay. Now, I think you are asking me if you should buy a government bond for 23% or a mutual fund at 21%. It's a simple answer, Joseph. And it's a simple answer. The loan is for 14%. You can't buy anything that you are not sure of getting more than 14%. You can't buy anything. So when you say mutual fund, is that mutual fund guaranteeing you 21%? If it's an equity mutual fund, it's not guaranteed. Even if it's a money market mutual fund, I'm not sure it's guaranteed. The government bond is 23%. I like that one more because you are taking at 14% to make 23%. So you've already locked in your profit. There's no risk there because it's the government. So you are borrowing from your company at 14. You are giving to the government at 23. You've locked the money in. No risk. You are going to make how much? 23 minus 14. How much is that? About 9% or so, risk-free. The only question is that if you want to quote unquote do more, then you are going to have to take more risk. And this mutual fund you're talking about is riskier than the government bond. If it's an equity mutual fund, I would not do it with a loan because it can go up to 100%, it can go down to 2%. So be careful about borrowing to invest in something that the value is not locked in. And there's no way you can hedge that. So I would prefer the government bond. It's going to be a simple, tidy exchange. You maximize that borrowing. If they can borrow you 100 million naira, borrow 100 million naira, take it and go and buy the government bond at 23% and make 9% risk free. They might even have some tax advantages there if you do the government bond. So based on your DM, Joseph, it's a simple thing to analyze. Remember, if you take a fixed cost loan, you don't want to invest in a variable return investment. I say it again. If you take a fixed cost loan, you don't want to invest in a variable return instrument because then you are chasing what you don't know. Joseph, I hope that makes sense for you. Great question. I love those kind of questions. Thank you. Dr. Smart, you've got the floor. Go ahead, sir.
Thank you very much, sir. So I just want to find out on this mutual funds, right? Can you give us more insight on money market, equity, mutual funds, and all? Or more specifically, right? Because I use this standard money market, standard mutual funds, really. So I was sort of wondering if you could give us more insight into
Can you be more specific? Where do you want me to focus on, if I may ask?
Yeah, regarding the interest.
Oh, I see. Okay, so I see, and I've seen the DMs as well. So whenever you hear a finance person say interest rate, he's always quoting a per annum interest rate. If I say 5%, I'm always meaning 5% per annum. If a bank tells you 4%, they always mean 4% per annum. It's always going to be a per annum. So just to answer those DMs, always 4% per annum. So Smart, look at it this way, right? And I'll try to share something if I can. When you invest, there are only two forms of investment. Number one, there's what we call fixed return. Fixed return means as you are investing, you know exactly what you are getting back. So fixed return. If I invest 10 naira today, the bank says I'm going to earn 10%. I know I'm going to earn 10% on my 10 naira. No argument. It's fixed return. I'm earning interest on my principal. Fixed. Guaranteed. No debate. The other investment is called a variable return. So when I buy a stock, if I buy Dangote Cement, my profit is based on how much profit Dangote Cement makes and want to pay me. They can make 100% and pay me 100%. They can make 1% and pay me 1%. So you see there's fixed and there's variable. Let's now go to mutual funds. Mutual funds are just a basket. They will take that basket and they put things in a basket. So they now sell it to you and you will say, listen, instead of you buying a Mercedes car, a BMW, a Toyota, a Lexus, a Tesla, just buy this basket. Once you buy this basket, you have bought all those car companies immediately. So when you buy a mutual fund, Americans call it mutual funds. Nigerians, we call it unit trust. Because Americans don't have trust, trust deed. In Nigeria, the real palace is unit trust in English, mutual funds in America. But it's the same thing. Even when you hear ETFs, exchange traded funds, it's the same thing. They are all a pool of funds managed by an investor on your behalf. So when you want to buy a mutual fund or unit trust, you want to ask yourself, are you buying a trust that is doing fixed return or is doing variable return? How do you know? You ask the manager, what is this unit trust for? If they are only buying bank loans, certificate of deposits, fixed deposits, treasury bills, anything that they know the interest rate in advance, that's the fixed return. And they usually will tell you on the, you'll see IBTC equity or IBTC fixed return. You'll see it on the name. If you're not sure, ask them. So if it's a fixed return mutual fund, you are only going to get a return based on the fixed return instrument that they have bought. If it's a variable return, right, then you are getting mutual funds, equities. You are buying into the profit and loss of a company. So most ones you see are sometimes equity. You can also have what we call a balanced, where you are buying half equities or half mutuals, but they will give you the percentage. That's basically it. When you hear me say VTI in America, that's a mutual fund or an ETF. That's an ETF that is invested in variable income, which are equities. When you hear me say BND, that's an ETF that is investing in a fixed return, which are like bonds and money market instruments. So smart, what you want to do is that when you want to buy anything, you tell the banker or you tell on your app, use your app, you say fixed income, mutual fund, or mutual. It will screen for you and give you only fixed income. Fixed income means that your principal will not increase. What you are going to get is that you are making a return on your principal. So it's what we call capital preservation, principal preservation. If you give a bank $1 billion, your 1 billion will not increase. What you are doing is that you are going to get return on your 1 billion. You see what point I'm making? Even if they give you 100% return, you are getting 100% return on your principal. But when you invest in variable income, you are investing in the profit and loss of that investment. So your principal can actually go up if the share price goes from $1 to $2. And your principal can actually go to zero if it goes from $1 to zero. Did I answer that question right, Dr. Smart?
Yes. That's cleared my inquiries.
Perfect. So you want to find out, ask them, make sure you look at the summary prospectus. Ask them for the summary prospectus and ask them, right? And then they'll be able to let you know what it is, yeah?
Yeah, thank you.
All right, perfect. Someone is asking, but let me get Buhari. I got Buhari Zayad. How you doing, sir?
Hello, Kalu. Good evening.
Hey, how you doing, my brother?
Thanks so much, as usual, for the education session.
Yes.
So, two things. The first, for example, as a civil servant, just to speak, who earns a salary and wants to diversify in terms of getting income, is it a good idea to get a loan from a bank with salary domiciliation as the comfort to start a business, specifically say trading, buying and selling? Is it a wise choice? That's one. Secondly, on the issue of bad debt, do we look at someone financing his luxury life, getting a loan from a bank or any other institution that would be able to grant a loan to him to finance luxury? Like, say, okay, he needs a car and maybe he gets a car. Should that one be classified as a bad debt as well? These two clarifications.
Explain that second one to me. You say bad debt, but say it again so I can understand.
Oh, okay. So someone getting a loan to finance a luxury, is that a bad debt?
I hear you. You've already answered the question. That's why you're laughing. You already answered the question. So I mean, look at, like I said, right? There's good debt. Let's do your second question first. There's good debt. There's bad debt. What is good debt? Good debt is debt that the returns are more than the cost of the loan. What is bad debt? The cost is more than the returns on the loan. That's basically what we're saying. So if I go borrow money, right, what have I done? Like I said, I've front-loaded my consumption. If I borrow 100 million naira and I buy a brand new Lexus Jeep, what have I done? I have gone to the future, taken 100 million of my earnings, brought it till today, and I'm consuming with buying a Lexus Jeep. It would make perfect sense if that Lexus Jeep, I'm going to use a Lexus Jeep as car hire or movie hire, and people pay me back money, and over the years I make money to service that loan, that when that 100 million naira hole comes, I have made so much money from renting that car out that I can cover that loan. So it makes sense. But if there is no income to cover that 100 million naira hole, how do you cover it up? It's going to be covered up one way or the other by you reducing your livelihood and your expenses. So instead of you going on holidays with your family when you are older, you'll find yourself paying a loan to a car company. That's the problem. So you want to be very, very careful about borrowing to invest not just in luxuries, but any venture that does not give you a return back. You know, when you look at how accountants do balance sheets, they will do assets and liabilities. But when financial planners do a balance sheet, we classify your asset in terms of, is the asset earning money for you? That's what we look at the assets. If you have a phone, let me give you a better example, Buhari. A brand new Apple phone, latest model, will cost you maybe $1,000. Is that phone in your hand, is it an asset or a liability? An accountant will tell you that that phone is an asset, full stop. But a financial advisor will tell you it depends on what you are doing with that phone. If I use that phone to make calls, to receive texts, to take selfies, it's a liability. It's not an asset. It's a liability. Because why? It's taking money away from me. I'm paying a loan to buy that $1,000 iPhone. But what if I use that iPhone, because of the memory, because of the graphics on the phone, to run my podcast? And from that podcast, I get folks that advertise on my podcast and I make returns for me. Of course, that phone becomes an asset because it's generating income for me. So the phone itself can be an asset, it can be a liability. Your car can be an asset, it can be a liability. That's accountancy is different from how financial planning, because if it's not bringing you money, you can have a house in Lekki that is worth a lot of money, but that house is flooded, so you can't rent it out. That house is a liability to you, not an asset, because it's costing you more money to maintain that house than you are making from rent. So it's not asset liability in the accounting sense, but is it giving you money or is it taking money away from you? That's how in financial planning I define assets and liabilities. I'm not saying accountants are wrong, but when you look at it that way, it clarifies many things for you, right? That's to answer your second question. So that answers your question without me answering it. Paul tells you it might not be a good idea to fund any lifestyle that you're not making money back from. Let me give you an example again, just to make it close to you. I saw Burna Boy, his parking lot. He had lots of Ferraris there. I saw what's his name, Davido. He's driving the latest Rolls Royce. Are those Rolls Royce and Ferraris? Is it a bad investment or a good investment for those guys to buy Ferraris and Rolls Royce? It's not a bad investment for them. They are in the business of entertainment. So they need to entertain and show you off. So if Burna Boy was driving Keke Marwa, nobody will follow him. He has got to drive a Rolls Royce to show he's an entertainer. It's like him buying a brand new iPhone. That's the same way he's buying a brand new Rolls Royce. So he can do that because it's his job to wear diamonds. That's his job. But if you work in a farm, your job is not to show off or to entertain, even if you have the money. So it's not going back to the example, it's not the income or the expenses. Is this thing bringing money for you? That's the question. Burna Boy is going to use that Rolls Royce to get more gigs. So that's why it's an asset for him. But if you go borrow money to buy a Ferrari, to drive the Ferrari, it's not an asset for you because you're not making any money from that Ferrari because you work in a library. I hope that makes sense on the second question. But let's go to your first question. Buhari is a very, very simple answer. You should, in no circumstance, go to a bank to borrow money to start a business. Whether in America, whether in the UK, whether in Nigeria. Banks are not set up to lend you money to start a business. No. You start a business with your family and friends and your own savings and equity, what we call patient capital. You don't want to borrow from a bank because when you're a startup, what defines a startup, Buhari? There's no cash. A startup basically means you don't have any cash. So if you don't have any cash, why are you taking the limited cash you are even making from operations to pay the bank. So what normally you end up doing is that you're going to be taking your principal to pay back that bank loan. That's why there's this question I always ask people. There's a statistic that shows that most businesses in Abuja close after 2 years. And I ask people, why do you think it's 2 years? Because 2 years when your rent expires. So the business has already died. But once it's 2 years, rent is done, then they formally close. You should not, so the answer is simple, but you should not go to the bank to borrow money to start the business. When you have started the business and then you need working capital, let's say you have a contract to supply. The guy says, if you supply me this, I'll pay you in 1 week. Good. You go to the bank. You borrow money from the bank. You supply. The guy pays you back in 1 week. You go back to the bank. You clean up. That's called, you close that cycle. That's working capital. You don't borrow from the bank to go buy computers, buy the car, buy the head office. Does that answer your question?
Oh, yes, it does. Thank you so much. I was reading a finance book and it was saying lately businesses should see borrowing money to start up a business as a myth. And you've clarified that. Thank you so much. Yep. Thank you.
You should never do that. All right, perfect. Yeah, glad to clarify that. So I have a question DM from, I love this question again. Technocrat is asking, should I do, what is the advantage of getting a student loan? With 20 years payment plan, of course, it's $400 spread over 10 years. Techno, I see all these numbers you have given to me, right? They make sense. But look at it this way. Let me give you the breakdown of student loans. A student loan is an investment. Someone is telling you that we're going to give you, I want you to pay me $23,000. And I'm going to give you a piece of paper. That piece of paper can change your life, or it can be a cost. It can be an asset. It can be a liability. The answer to student loan is this. Will you get a job that can pay back $23,000? That's the only answer. It's not a numbers question per se, Techno. It has to do if you invest $23,000 in something, no matter the interest rate, will you get a return that would pay back $20,000? That's your question. If you are doing IT, of course, the answer is usually yes, because the IT folks are not sure how they may do it, but they're able to make a lot of revenues from their certification. Maybe they go and do Python or whatever I don't know the name, but they get a lot of revenues, i.e. salary revenues that can pay back their loan, right? Same thing with, say, a certified financial analyst. That certification is in demand. It's an international certification. If you get it, you're able to get a good job to pay back your loan. So it's a question really of what are you getting? When you say MBA, International Business Program, I would say don't do it. Not with a loan. Because MBA is, and I have an MBA, so let me just make sure no one gets me right. MBA is like water. If you want to do an MBA, you want to borrow money to do an MBA, borrow money and go to Harvard. At least you get the network, and then you can say, I'm investing in the network. There is nothing Harvard will teach you that the business school in Onitsha will not teach you. Trust me, the difference is this. In Harvard, you're going to meet the folks that will be CEOs in 10 years. In Onitsha Business School, they might be CEOs in 10 years, but they're in Nigeria. So which one has more currency for you? Harvard or Onitsha Business School? So it's not really techno. You get my point, right? It's not what you are paying for. It's not what it costs. It's what you're going to get from that. If somebody tells you, forget the education part. Let's say someone tells you, buy a ticket. This ticket is going to cost you $23,000. And this ticket, you're going to have just two outcomes. You're going to have up or down. Up means if you buy this ticket, you get double. So you spend $25,000, you get $50,000. Or if you buy this ticket, you're going to get zero. So it's a binary choice. You give us $25,000, you buy a ticket that's going to go up $50,000 or down zero. Would you do it? Would you take that risk and say, if I spend $25,000, I'm going to get $50,000 or zero? That's number one. Number two, the MBA you want to go for. MBA is you are buying the school name, not the education. Forget that thing they tell you. You are buying the name of the school. If somebody applies to your company from Harvard. You will take him and you put him on your another report and say, we have this guy, he's trained in Harvard. That's why you see anyone that goes to Harvard, they always put it there. Harvard alumni, MIT alumni, Sloan School alumni, Yale alumni. Why? They are telling you they went to this unique, very, very exclusive place. And that currency, that exclusivity is the currency. That's what you're paying for. It's not what they learned in that school. It's who they can call and say, okay, I was in Harvard with this guy. You're an Harvard alumni. So if it's just going to be an MBA international program, I wouldn't do it. If I have the money, I would do it. If you have the money in your bank account, sure, do it. Add it to your CV. So if you want to go for, I don't call any name school's name, and you have the money, do it. Add to your program. It favors you. Your CV is, it helps your CV, but don't borrow to do it, unless it's those marquee, unique schools that you can then relocate even because you did that. If you're just you're gonna spend all that dollars to get a run-of-the-mill business program, I wouldn't do it. I wouldn't. If you're gonna go to China and learn Chinese to do one international program, they're gonna live in China. Fantastic. But if it's just gonna be an MBA program, what's it gonna give you? MBA. Unless you're gonna use that MBA program in Nigeria and become CEO based on your MBA, then it makes sense. But in Nigeria, we don't roll like that in Nigeria, right? In the UK, US, they roll with where you attended. Yale. How many presidents have Yale brought out? Obama was Harvard. The VP we have today in America, Yale. Even Trump, Pennsylvania school he went to. So they all roll like that. But if it's not that, be careful. If you have the money, do it. But if it's something you're going to borrow, be careful. If you're going to borrow, then invest in a school that has name. So you are buying, in quotes, the name of that school to help your CV. Because it's a business, man. Yeah, it's a business in the end. All right, thanks. Thank you, I appreciate that. That's just my opinion, right? Again. So let's get the fair... I am Ododo, the fair me. I am Ododo. Hey, what's up, man? Hey, what's up?
Good evening.
Yeah.
Hi.
How you doing?
So I'm speaking from Nigeria, from Lagos, Nigeria. Yes, can you hear me, please?
I can hear you perfectly.
Okay. I'm speaking from Lagos, Nigeria. I wanted to know your opinion regarding taking a lease and then renting out. So there's a property on my street. I can take a lease for 7 million, right, to own that property for 15 years. I do not have the 7 million. However, I am eligible for a loan that can give me that 7 million. The loan is going to be 23% per annum for 2 years. Do you think it is wise for me to take that property? So bearing in mind that if I'm going to lease the property, I'm not going to stay there because I already rent a place on that same street. I'm going to rent it out for, say, 1.2 to 1.5 million per year rent. So what I'm considering, or the factors that are making the decision a little bit harder, I'm sure if you hear the figures, it sounds like a great thing, but I'm also considering time value of money. So if I take that 7 million, for instance, and I put it in mutual funds, I can probably get 20-21% per annum, which would almost amount to the same figure I would have gotten if I was renting the apartment out, right? Then again, also owning that property for 15 years, I could decide to maybe do short lets if I want to be a little bit risky or something. So those are the factors that are weighing on my mind. I don't know what you think about it.
I mean, your question looks like a real estate question, but it's actually a question about should you invest in Nigeria, looking at the interest rates and the inflation rate. That's really what your question is. I have friends that do exactly this business you're talking about. So they get leases, and they've come to the space, I think, 2 or 3 times. They do leases in Lagos. They get a building, and they convert that building to short-term leases. Then you can invest with them and own the short-let apartment, and then they manage it for you. They've now even gone to owning the building themselves, being very successful. They've come here 3 times. If you follow the space, you will know about them, right? And they've done pretty well. So But look at your question. Like I said, it's not a real estate question. It's a question about if the risk-free rate in Nigeria, risk-free, without doing anything, is 21%. Let's say it's 20%. Why would someone take the risk and invest in something that's going to pay him 30%, 25%? That's really your question. And that's the problem with Nigeria and high interest rates. If I have $1 billion, I can make 200 million naira without lifting a finger. If I have $1 million, I can make 200, no, not, if I have 50 million or 100 million, I can make 20 million every year without lifting a finger. With 20 million, I can pay my driver, pay my cook, go from somewhere in Malta and come back. I don't have to do anything. I don't have to chase workers. I don't have to chase title, nothing. Because I'm earning 20% risk-free. So that's what question you're asking. You don't have 100 million of your own. You want to go borrow at money, incur the risk that if that loan fails, you're on the hook, because Nigeria does not have non-recourse loans. They're going to come after you if that project fails. You have to pay. You want to take the risk to invest in that project, and you want to make a return that will first of all pay back the bank or whoever you're lending money from, and number two, make it worth your while. In finance, there's something we call capital asset pricing model. That answers your question by doing the official numbers and all that to say, hey, is it worth it? But let me ask you a question. Come back to yourself. The return you think you are going to make, you've done your modeling. What's the return number you think you're going to make? If everything goes as you have planned, there is no wahala. You invest this money, you buy this building. What's the return you believe you're going to make? All in, no issues. What return you make?
So I have a higher risk appetite than most. So I was thinking of shortlet. If I was to do shortlet, I would make, say, 3 to 4 million.
No,
and that's conservative.
In percentage terms, could you do what's the percentage?
In percentage terms, let's say about 40% per annum. 40% rise.
Okay, so the risk-free rate in Nigeria, right, is the rate that we look at the treasury bill in Nigeria. Whatever that rate is we can use that as our risk-free rate. So treasury bill, I think the last time I saw it from 50 million naira was nearly about 19 to, let's say, 21% for 1 year. So what you're saying is that if you get an extra 20%, that would compensate you for the risk that you are taking. That's basically what I hear you saying. Because the risk-free rate, if I have 100 million naira today, I can go to my bank, give them that 100 million naira, tell them to buy me treasury bills. My bank will give me 20 million guaranteed. No wahala. If I give it to you, you are going to give me 40%. So the question is, that extra 20%, does it compensate me enough to invest in you? That's the point I'm asking you. I think it's okay. So you also have to ask yourself that question. If everything goes well and you can make 40%, you are just barely beating inflation, number one. And number two, you are just covering your bank side. But there is no rich person that didn't take risk today. None. If you do this project and it works out, it's on your CV, you can go back and say, I did this, I want to do more. So you're asking me a question, should I take risk? It depends. Can you take it? Are you feeling lucky? Do you get the point I'm making? No one's going to answer that question for you. No one's going to tell you, take risk. But you've got to do your modeling correct. You've got to do a lot of sensitivity in Nigeria. You've got to say, what will happen if exchange rates goes to 1.8? What happens if it falls to 1.1? What happens if inflation goes up? You've got to do that modeling. But I also think it's a good business. It's a good sector. If we do the rebasing, you're going to see that real estate is going to really blow up in Nigeria. It's all about location, location, location. Where is that building? Remember, you are targeting for shortlets. Who does shortlets in Lagos? The guys that come, the Jackpad, the guys that have money, the upper ender people. So they want to go to where it's considered safe. If you go and put a shortlet in some locations, they won't go there. If you have a shortlet in some locations, they will go there. So I would say really, really get your modeling numbers correct. If you can get your modeling numbers correct, try and get a very, very low cost of equity. If you can, my friends, I've told you that come to the space. If you notice, they don't go to the banks. They raise money from the owners that want to own that short-let apartments, the reason why they're not going to the bank, the guys that have done it that I know, that have come here more than 3 times making a lot of money, they don't go to the bank to borrow. So that's for you to consider. If you can do what we call other people's money. So if somebody wants to invest with you, perfect. That's patient capital, right? You can do more with that sort of capital. If you go to the bank is going to charge you every month without fail. Every month. You're going to pay for diesel without failing. So do your modeling correct. It's a good sector, but it needs cash flow. In this business, they're going to invest upfront and then recover. You see what I'm saying? You're going to invest a lot of your money upfront. Then you want to do recoveries. Unlike a trading business whereby you have goods, you buy, you sell, you are Binance. You're going to invest the bulk of your money upfront. It's going to go, cash will go out. Then you start recovering cash. Very risky.
Okay, thank you very much.
Try to talk to people. Try to talk to people that have done this before. Do you know the guys I'm talking about that have come to my space for short-let apartments? Do you know them?
This is the first time I'm joining your space, actually.
Okay, if you send me a DM, I will try to connect you with them. Just go and talk to them. Just say, Carlos sent you want to do this business. Just talk. They are very nice. I'm sure they will just talk to you for 30 minutes. Just speak to them. Make sure you know what you're doing. Like the modeling numbers have to look right to make sense. Because anything to do with Nigeria, you have to do your modeling properly. Otherwise, you'll be in a lot of trouble, especially if you want to borrow. I prefer equity than debt in Nigeria, just because it's cheaper in Nigeria or not anywhere else. Makes sense? I like that question, though. Thanks so much.
Thank you. Thanks for your help.
Hey, perfect. I've got, let me see, he dropped off. So let's go back to DM. DM is asking, Kalu, can you talk about crypto? We always get crypto questions. Can you talk about crypto? Is it a good investment? Is it something I should do? I've been trading crypto. The normal questions. So you see, the thing with this crypto thing is this, right? Now, because of the new administration in America, they seem to be crypto friendly. Every day I wake up, I read about a new state in America that is going to do strategic crypto reserve. I think it was Ohio that did one, then Wyoming, then Miami. So you read about all these things happening. Even I think is it in Canada, Alberta also wants to do crypto reserve. So there's a lot of noise around crypto, especially Bitcoin. In America now, you have ETFs that invest in Bitcoin. That's a big deal. That means that the largest institutions in the world have adopted Bitcoin. They've said, okay, this particular one is okay, and we can invest in it. So I buy Bitcoin through my bank. I don't buy it through the exchange. I go to the bank site, I buy it. It's that mainstream now. This was an investment that a few years ago was considered as very, very risky and not even worthy of being invested in. Today, if you go to your bank in America, there are ETFs, BlackRock and the rest. There are ETFs that allow you to invest in Bitcoin alone. Right now, you've seen AI, you've seen a lot of noise around it. So it looks like there's going to be a market for this thing, and that it's going to be not just holding it because it's scarce, but there might be utility for it going down the road. It looks like. But still, we don't know what these things do. When I mean we don't know what these things do, everybody says Bitcoin, but how many transactions can you do in Lagos with Bitcoin? I liked it. There was a guy I saw on TV in America talking about that. He was a real estate guy, and he was saying that the way they finance real estate now, or how his firm finances real estate, is that when you come to them to borrow money, let's say you want to borrow $10 million, they will borrow you $12 million. Then they will tell you to use the extra $2 million to go buy Bitcoin. So what they are doing is that they are buying Bitcoin to give the project liquidity and safety. So when you are building the house, you have this 2 million Bitcoin that you bought when you took the loan, and it just sits there. So if something happens to the house, maybe there was a fire or folks did not buy the house, in their mind, they can sell that 2 million Bitcoin and do recoveries So, you borrowed 12 million, but you only wanted 10. They gave you 2 million to buy Bitcoin. So in their mind, the Bitcoin price is going to stay more stable than even your home that you are building. So they're able to use that Bitcoin as collateral or to guarantee the cash flows of that real estate investment. If we start to see more of these things start to happen, where people are finding innovative ways to use crypto, Bitcoin, and the rest to do normal transactions, then this thing can really, really take off. When I mean this thing, cryptocurrencies or crypto as a utility can really take off, because then people will see, oh, I can use it for this. There's a blockchain. You can use blockchain for elections, for currency, which is what Bitcoin is. But if this thing really takes off, where Wall Street is able to make it mainstream, then of course it's a good investment, right? But I wouldn't say, be very careful by putting more than 10% of your portfolio in this. If you want to invest in this, there's 1%, 2% of your portfolio. I wouldn't say that's a wrong thing to do. But putting 10% is taking it a bit. You are making the larger part of your portfolio for now. Unless, of course, you can accommodate that risk and you think you're a younger person, you can catch up. But be very, very careful about buying into something that we don't yet have regulations on yet. No matter what the guys today are saying, there is still no definite regulation on crypto, blockchain, and all that. They are talking about it, but nothing final as it were. So until we get something final and definitive, just be careful a bit, right, in how you want to invest in that space. Nigerians buy it because Naira is a bit, should we say, weak. So Nigerians like to buy crypto because it's sort of is a hedge against investments and all that. I get it. And lots of Nigerians make a lot of money from it. I also get it, but just be careful. Still today, you can't go to a bank and open an account and say it's a Bitcoin account or it's a crypto account. They won't let you do it. But Nigerians are doing it because they have to. It's also the way we transfer money from America to Nigeria through PIP. I get that part. So in Nigeria, in India, in all those Brazil, in all those countries, it's a big thing. But for now, until America, the UK, the West adopt it really and it goes mainstream, it's not something you can put more than 10%. It's not something like an equity you can buy more than 10% in. But it does make money for you. I won't lie about that one. So keep that in mind. All right, guys, next DM. I like this one. Carlo, just to be clear about the credit cards, again, I just want to be sure. I already have credit card and I'm owing a lot. I have 2 credit cards and I've maxed them out, and I'd like to take a third credit card because this third credit card allows me to do a balance transfer. Am I doing the right thing? Okay, so this is a great question on you are already in debt. How can you come out of debt? And credit cards, like I said, are very, very easy for you to get into debt because they are very easy to use. A credit card has a trick. And you have to remember this trick that banks used to get you. When you are given a credit card of $1,000, if you spend that $1,000, all the bank wants from you to say you have paid is 2.5%. So if you spend $100 and you pay $2, or let's say $5, to the bank you have paid. That's it, you've paid for the month. So you can carry over $95. Why does the bank do this? Because when you carry over $95, they charge you 27% or whatever the APR is. That's the trick about credit cards. They do not want you to pay everything in full in the month of usage. So it becomes very, very easy to use. So if you have a loan or if you have a bill to pay, you put it on your credit card. But if you put $100 on your credit card, you only pay $5. You see? So it's easy. If you go to the store, you buy $200 worth of goods, you only pay $10. You're fine. The bank lets you carry over that 180 to next month. So you keep on carrying over until you've maxed out the card. And when you max out your card, it's the same as if you are not paying. You lose that 30%. Your credit score will also come down. So now you're in a big problem because now you have been living your life on credit. You don't have the money to shop in the grocery store. You don't have the money to even pay your rent, but you've been paying it on your credit card. Now your credit cards are maxed out. You can no longer live that life anymore. So what should you do? You want to come out of debt. So how do you come out of debt? We have 2 ways. We have the avalanche and we have the snowball. I always get confused about which is which, but there are two ways to do this. The first way is to say you write down everything you are owing. So you write down all your debts. You do your credit cards, your personal loans, everything you are owing, you write it down. Then you write the cost of the loan. So that's the interest rate, what we call the APR. You write down the cost of the loans, the interest rate to the APR. Then, of course, you write the amount. So you have all your debts, the cost of the debts, and, of course, the amount. So there are two ways to pay your debt. The first one is to pay the debt with the lowest amount. So if you owe, like this guy owns 2 credit cards, maybe he owns a personal loan. Let's say he owns 5,000, 4,000, 1,000. The first method is to pay down the debt that is charging you 1,000. Why? Because it gives you an early win. So psychologically, it helps you. So you own 5,000, paying 10%. You own 4,000, paying 5%. Then you own 1,000, paying 12%. So you are paying down that first $1,000, so your initial quick win. And once you pay that loan off, you take that money you used to pay off, you now start to pay off the other loans. So you write your loans down, you pay off the lowest amount, then you take that same money and you attack the next loan to pay it off as well. What's the advantage? You get an initial early quick win. The other method is that instead of you paying the lowest amount, you pay the highest interest cost. So if you have 3 loans, you pay the one with the highest interest cost first, not the one with the lowest amount. So if you look at the loans, you have 5,000 at 3%. You have 4,000 at 10%. You have 1,000 at 5%. You pay the 4K loan that has a higher interest rate first, because that's what's taking money away from you. So if you pay that one first, you are reducing the cost of the loan, even though it might take you longer, but the cost is reducing because you are paying it first. If you look at all your loans, your credit card loans are always going to be the highest APR, always. So you want to pay those ones down first. So what he is trying to do is to take a new credit card and do what's called the balance transfer, where you can take the balance from your old card to this new card. Usually when you do this, the credit card company will give you a time before you start to make your payments with interest. So you are doing a good job on doing the balance transfer, but make sure you get the one with the longer. And you didn't mention how long your balance transfer, your 0% APR on the balance transfer is. If you want to do that, make sure you get a credit card with a very, very long period before you start to pay interest. So that gives you more time to pay off your credit card that has those high balances. Transfer the credit card with the highest APR first, not the credit card with the highest amount. So I don't know how you just said you have 2 credit cards. So out of the 2 credit cards, which one has a higher APR, higher annual percentage rate? Transfer that first to the new card and then try to then pay it off. You now have more time to pay it off. You've taken it away from your old card. You then have, if it's a year they give you, try to pay it off within a year. So balance transfer is a great way to do it. And once you do this, you want to now look at your budget and try to establish the budget. So going forward, you don't fall into a debt trap. You're in a debt trap, bro. If you don't come out of it and you get stuck into it, you're going to be in serious trouble, right? You don't want to cancel a card, or you don't want the card to cancel you. You don't want them to put your name down with the credit bureaus that you don't pay your debts on time, because that would really bring down your score. You get a negative mark on your credit. So you want to avoid that. Whatever you do, you want to avoid not paying your credit card or any loans, because they get reported and to affect your credit score. So please, do this credit transfer you're doing. Transfer the one with the highest APR. Get that going. Then you need to really cut down your expenses and start to pay down your credit cards. You need to really cut down your cable, cut down everything else you're doing, and just focus on debt repayment, right? Great job. I just lost Darkball. Darkball, I was going to invite you to speak, but you just dropped off now. So I'm going to add you back. Darkball, if you come back on time, I can take your question. I'm going to go back to DM again. Yeah, just want to talk about mortgages. Yeah, so this is a great question, but I think I wrote an article, guys, about mortgages. And the article was titled, How an Immigrant Can Buy a House in 36 Months. So I gave you step by step, not theory, step by step, how you can go from you leave Nigeria, you go to Europe, anywhere in Europe, you can buy a house in 36 months. And I put qualifications there as well. Number one, you have to have a job. Once you have a job, I can get you a house in 36 months. You have to have that plan. And if you want to Google it, just go online. I wrote it for Nairametrics, or just say how immigrants can buy a house in 36 months, Kalu Aja, Nairametrics. That article should pop up. And I'll give you, because that's what you're asking, Cyber. That's what you're asking on your DM. Let me explain to you. To buy a house, you need three things. Number one, credit score. What number? I would say minimum 700. Minimum 700. Number two, you need to have your down payment. So you want to save some money down because they're going to ask you to do a down payment. So number two, down payment, right? Number three, it's your credit score, down payment, tax returns. You need at least 2 years tax returns, right? So let's say you leave Nigeria. There are a few things you want to do when you live in Nigeria. If you have money in Nigeria and you want to japa, make sure you have a paper trail. So if you sell your car, collect the check, pay it to the bank account. Pay everything to the bank account. Don't collect cash. Even if it's your friend, just write me cash. Just write me check. Collect check, pay it to your bank account. Right? It shows up on your bank account. Cut yourself a check. Print your bank account. Take it with you. Number one. So you want to establish a paper trail of how you got money and you are taken to the United States. Especially, I know of UK, I know of America, right? So you have a paper trail where you sold your assets, you sold your house, you sold your car, you paid to your bank account, it's in your bank account. You have the account statement. Print your account statement, get the bank to stamp it, put it in your pocket, you travel. When you get to America, what's the first thing you want to do? You want to get a job. You want to get a job. Why are you getting a job? Because you want to show income. You want to show end income so you can pay taxes. You don't need a job to pay taxes. You can pay taxes in America without a job, but get a job. If you don't have papers, that's a different matter. If you don't have papers, you can still pay taxes. So let's say you don't have papers, still pay taxes. How? You apply for a tax identification number, TIN. You can still pay taxes without having social or being a citizen. But let's assume you emigrated the right way and you are there. You are now getting a job. So you get a job so you can show end income, right? When you get a job, next thing you want to do, you get a credit card or a personal loan. Don't wait. If you don't have credit score, go to a credit union or to any bank and say, I want a secured credit card. I would say do two of them. Get a secured credit card, get a secured personal loan. Two of them. It's the reason why I'm asking you to get two of them. You don't have to put big money. You put $500. It's your money. So you put $500, $500. It's not going to cost you a lot. It's your money. You put the money on the credit card, you use the same credit card and buy your groceries and you pay back. So you have established credit, number one. Number two, you have established end income, number two. You do this for at least 24 months. Remember, you go to America today, Abby. You do this for 24 months. So for the 24 months, you have your credit card running. You have your personal loan running, secured personal loan. It means you don't need the money. It means you give them your money. They give you a personal loan and you do auto payments back. It sounds confusing, but Google it. Secured personal loan, secured credit card. So you have a job, end income. You've paid taxes in year one. You've paid taxes in year two. You have a credit card and a personal loan that you have been paying without fail for another 24 months. You have your bank statement showing that in Nigeria, you paid all your assets. You have that $10,000 cash that you brought with you from Nigeria to America. You have it with you. You have the proof where it came from. If you have people giving you money in Nigeria, that let's say your mom has money and your mom's going to give you money to buy a house, your mom will write a letter saying it is a gift to you. She does not want you to pay the money back. She's giving you a gift. She'll write a letter. You take that letter, you keep it with you. You now go to your bank. This is after 24 months, Abi. We're now in the third year. You go to your bank. What will they ask you for? Tax return. You have it. 2 years you've been paying taxes. Credit score, they're going to pull it. Because you've been paying your credit card and your personal loan without fail for 24 months, you're going to have a very, very high score. It's going to be more than 700 without fail. You will also have 2 years of returns, so you get that extra 10 points. You also have no inquiries. Don't try to apply for another card. You don't need another card. Just need that one credit card and one personal loan. Just leave it like that. Highest 2, but don't try to apply for more. You have no inquiries. You've done good. They will pull your credit, number 1. They will pull your tax return, number 2, based on your income. Based on your income, they're going to use what's called a debt to income to tell you the kind of house you qualify for. The only thing you can't change is the kind of income you make. Don't wait and say till I make big income, I will go and buy the house. Even if you work in Amazon and you're parking, or you work in Walmart, you still have income. The bank will tell you based on your income, you can afford this kind of house. So now you've qualified to get the loan. You go to the bank. Bank says, we're going to give you a pre-qualification of even if it's $40,000 or $50,000. You have that one from the bank. You have your down payment you sold your money your assets in Nigeria. You have the money in cash in the bank. You have a letter from your parents or whoever is giving you money in Nigeria. You have your bank statement. You have all that. The bank will take all that from you. What house should you buy the first time in America? You don't go and buy the house you like. You buy the house that you can rent out. So when you go to the city, you want to buy a house in a place where you can rent out. There's a reason for this, guys. Let's assume you are not married. Perfect. If you are married, don't have kids, this is perfect for you. You buy the house where you can rent out. So you go there because you might not have enough income to get your house in the suburb. So you go and get a house you can rent out. Even if it's 1 bedroom, you buy that one. You stay there. You have entered now the mortgage business in America. Once you are in that house, you can stay 1 year. You build up your equity there. You can, when you now have kids, move to the house that you want in your own school district, because now you have a house. You can rent that house out. It's now income. When you go back to the bank to get your second house where you really like, where you have the school district, that house is going to be listed as income because they're going to leave that house, rent it out. So it's income in your balance sheet. The bank will consider that. You have income from your job. You have income from your house. You can then get the house that you like. That's how you do it. You get in at lower end. You move on. Let's say you are married, you already have kids, so you can't do this, go and get a house in a rental area. That's fine. You might need to do more. You might need to buy a smaller house today before you get to the bigger house. In America, people buy homes based on school district, not that the road is fine. It's because it's your kids. So if you have kids, they need to go to a particular school, that's why you spend more, unless you do the commute. But that's how you want to do it. But the elements are the same. Tax return, which you get from 2 years. Credit, you do that, you don't waste time, you do it immediately so it counts for you. 24 months start to count for you. Secured, which means you don't need a credit score to get a credit card. Secure credit card, secure personal loan, tax return, savings for your down payment. That's your money you brought from Nigeria. Or if someone's going to give you money from Nigeria, you want to make sure you have it in a letter saying, this is not a gift. This is a gift. It's not a loan. I'm giving it to him. He's not going to pay back. All right, guys. So pull up the article. It's detailed. It's listed. I listed the steps for you one by one by one by one. So it's not theory. That's what I do, right? All right, folks. Excellent. All right. So I've got BYS. You guys should speak. I have a lot of DMs. I really want to speak and have an interactive session. I have BYG saying, my question about the government bond, how can I buy it? If you want to buy a government bond, just speak to your broker or your banker. We have treasury bills, we have treasury bonds, but those ones are from 50 million. So you can buy that one directly, or you can buy a mutual fund issued by a broker or a banker. So talk to your broker or your banker if you want to buy into a bond. Number 2, can I opt out and get my principal? Sure, you can sell at any time. Just ask them that if you sell before it's matured, what do you get? Remember, if you buy a mutual fund, there's no maturity. You're just buying into a fund. You can sell your fund and move away immediately anytime. But when you buy the treasury bill from the market, primary market, you have to hold for till it matures, or you can sell during and just get your discounted money and go away. There's no penalty. If people will buy it from you, you can just get your money and walk away. So yes, you can get your principal and opt out. That's no problem. Is there any background check to buy? There's no background check per se. Just speak to your banker. I think Nigeria likes to do, the money has to be in Nigeria and all that kind of stuff, KYC. So as long as you have a bank account in Nigeria, tell your banker, tell your broker, they will buy it for you. It's a normal KYC that they do. They will do that for you and you're able to get that loan. I got Foles. I got Foles. Foles_King. Guys, this is we're having a great session, right? Foles_King. What's in your mind? Talk to me.
Yeah, thank you so much, Kalu. Really thank you. Confirm if you can hear me, please. Can you hear me?
Yes, I can.
Okay, awesome. So, I've been following for quite a while, but good evening, I'm on your space. I want to ask this question because, most folks have been asking questions as it relates to personal income, right? If I'm going to put you on the spot, right? If you have an opportunity to to get a loan, right? Would you prefer to get it on your personal account or probably on your business account? That is, if you want to use that debt to increase your assets, would you prefer it being on your business account or on your personal account?
Just on my business, because I can do more, deductions, tax deductions from the business side. So if I have a business account, there are more expenses I can write off than on the personal side. That's just the reason why I like it on my business side.
Okay, awesome. Now, second question is this. So I'm currently in Kigali, right? Relocated sometime last year, February, to expand my business operations here. Would you advise someone who got into the country, right, wanting to own real estate property for the aim of course, advancing his ambition of getting citizenship? Would that be a wise investment from your end, based on experiences that you've had and conversations that you've had as well?
I think it depends on what the country's laws are. So they're all country specific. In America, they have laws about how you can buy property to get citizenship or green card. So you have to find out the laws there. If the laws there say it's possible, yeah, sure. If you have the money, it's an expensive way to get citizenship. It's more like property should be more of I want to invest. And Rwanda is very, very liberal in terms of immigration and business. So I don't think you need to worry about, if you are there, they're not going to come kick you out. So if you want to invest in properties because of the returns, not because you want to stay or for immigration, if you get what I'm saying. So your criteria should be, is it a good investment? Rather than, should I want to buy this so I can get a passport from Kigali, something like that, yeah.
Okay, all right. Listen, thank you so much. Because I invited a couple of my friends over. We're having this conversation, I think, on Friday. I have them over here. So, I just said to bring that up so, they could learn from your experience as well. Nice. Thank you so much, Mr.
You're welcome. You're welcome. Have a good one, yeah? I appreciate you. Let's get Enwerum Ignatius Chuzobam, MP. How you doing? Enwerum? Enwerum can hear me, so let me go to Izechuku. Let me add Izechuku back in there. Enwerum, I added you and you're not speaking.
Yeah, I can hear you now.
Yeah, please go ahead.
I can hear you now.
Go ahead.
Good evening, and thank you, Mr. Carlo, for this exciting episode. I speak from Kaduna State, Nigeria. And my question is this: as a civil servant, is it wise for me to borrow from a staff cooperative outfit at a rate of 10% to invest in Nigerian shares? And this loan will be payable in 2 years, and it will be deducted from my salary. So will it be a nice financial investment to do? Thank you, sir.
So let me make sure I use my words very carefully. So there are two questions there. You're asking, number one, should you borrow from a cooperative? The answer is, at what interest rate? You give us that interest rate at 10%. So 10% is lower than the cost of inflation. So on the surface, it looks like a very, very good loan, because if I borrow, I'm borrowing lower than inflation, which means that I have one leg good. I simply have to look for something that can pay me 10 plus and I'm okay. So once I get 10 plus, I'm okay. So the first part of your question, we've passed that, we've answered it. If I can get any investment that can pay me 10 plus, I'm okay. Let's now go to your second part. You say you want to invest in shares, in equities in Nigerian stock market. Now that's a problem. Why is it a problem? Because shares are what we call variable return. The returns can be 100%, the returns can be 1%. So if I borrow at 10 and I invested in the stock market last year the market did about 36%, and I've made money. So it's really down to, do I think the market will make 10 plus in 2025? And no one can answer that question for you. It is a risk that if it pays off, you make money. If it doesn't pay off, you're going to lose money. But they always say the past is prologue. But in investment, we always say past performance should not be used to judge the future. If you look at stock market returns across Nigeria for even the last 20 years, many times the only investment that has beaten inflation in Nigeria has been the stock market. Last year, the stock market beat inflation. Last year. So it's a question really for you. Are you comfortable taking that risk to invest in 10% in a market where it has a propensity to beat inflation, but the risk of even 1% would make you not meet that return? The question is this: how are you hedged? If you take that 10% and you invest in the stock market and the market returns 5%, can you still pay back that loan in 2 years without anything happening to your net worth or seriously harming you? If you can, it increases the option of variable market. If you cannot, I will not advise you do that. I would advise you go, like I told that gentleman, you're having 10 plus. We have the safest investment in Nigeria is savings bonds by the federal government. They are paying 12%. That's only 2% for you. If you want to take the risk, go and do money markets, mutual funds or unit trust. They pay you more, it's still more secured. So the answer is, if in 2 years the market is zero, stock market is zero, will you survive? If you can survive, it means that you have a greater propensity to invest in the stock market. But if the market is zero and you can't survive, I would say don't even think about it.
It's all right. Thank you very much. Yes, it makes sense to me.
You are very welcome. Ese Chikwelu, how are you doing, sir?
Thank you, Dad.
What's happening? I can't hear you. If you can hear me, I can't hear you. Oh, I think he's speaking, but I can't hear him. Ese,
Yeah, I can't hear him as well.
Yeah. So he dropped off. Let me get Tall Nero. Tall Nero, what's up, man? Thank you for confirming.
Hello, good evening.
Good evening, sir.
Thank you very much. It's a lovely thing what you're doing here. Every weekend I'm always here and I learn things.
Thank you. Appreciate
Today
it.
is just I'm learning the things about debt and everything in America. I wish you talk more on the whole thing about Nigeria. I do understand that you stay in America and the rest of it. So I'm in Nigeria too.
I stay in both. I stay in both places, and if you ask me a Nigerian question, I answer. I stay in both. Nobody has asked me Nigerian. They've asked me Nigerian questions, I've answered. So the problem with Nigeria, we don't have a very, very developed credit market. We have credit scoring in Nigeria right now. We used to have credit cards in Nigeria right now. We have a lot of. We don't have mortgages in real sense in Nigeria. That's just a problem. So it's difficult to talk because the breadth is not there. But if you ask me a question in Nigeria, I'm answer. Yeah, go ahead.
Yes, like I said, I was listening to. But the thing is, when you mentioned, what captured my attention was when you mentioned that you can, when you use your credit card, you have 30 days before you start accruing interest. And that's very nice. I was hoping that something like that in this country. So, because it will really help. I had a friend that did that for me last year. They usually give me interest. I pay back at the end of the month. I used to support my business and all. And it really helped me a lot. Even though that this year I don't think we'll be doing that again because he has a lot of things that he's doing. But if, in this country now, banks or whoever that is in charge of credit offers those kind of things, I haven't heard of it before. Actually, this is the first time I'm hearing it because every time they talk about borrowing, there's always interest, and it doesn't take up to 30 days before the interest starts accruing. That's one. So the second one is what are your, I don't know if I'm taking it outside the study, but what are your numbers that you look out for before you go into any stuff? Like from the company's financials, what do you look out for before you buy the stuff or when you want to sell it?
Yeah, great question. So let me talk about the credit card. So it's not 30 days, it's what we call the cycle date. It's most times it's 30 days, it can be 22 days, but the credit card company will tell you. So it's not a fixed 30. Make sure you find out what the cycle date is. That's how long you go from when you use the card to when you have to pay, right? So make sure you find out that number. And it's all credit cards, even the credit cards in Nigeria, if they have them, they all have a cycle date. You swipe on the first, you have a time that you have to pay back that card. If you don't pay back that card, then you then pay interest. You don't pay interest when you swipe. You pay interest on what you carry over to the next cycle date, if that makes any sense. So make sure you find out, and then the company will let you know. That's on your first question. So on your second question about what you look out for in the stock before you invest. So you have to, let's ask ourselves, what is a stock or a share? I think the word describes that I'm buying a share of a company. So let's use football analogy, because people tend to understand when you use football analogy. If I were to buy Messi, is Messi a good buy? Today, everybody will say, of course, Messi is a good buy. Of course, Messi is a good buy. So let's say Eyimba Football Club in Aba wanted to buy Messi. They can't afford him because right now he's worth millions. You can't sign him. But Eyimba could have bought Messi 30 years ago. Because back then, Messi was worth maybe how much? Maybe $10,000. So I'm just using examples, right? So what should Eyimba have looked at if they saw Messi training in Aba and they wanted to buy him? Number one, they have to ask themselves, is this footballer going to make money? Is he going to be a good footballer in 30 years' time? That's what they want to look at. They want to look at, that's what's called the intrinsic value of Messi. He can trap balls. Look at how he can run and dribble at age 5. So because he's showing us these flashes, we believe that in 30 years' time, he will get better, he will win market share, and he will even be the best in this field that he's doing. So when you look at Messi at 5 years old, you want to value him then with a mind to the future. It's the same as a stock. So I asked myself, will Messi make more profit? How do I know he'll make more profit? Okay, can he trap ball? Can he run 10 kilometers? Can he dribble? Can he head? Can he do free kick? These are all things I'm looking out for. Same with stocks. What is the market share of this company? What is the company selling? And what the company is selling, can it grow market share to beat competition in the future? A stock price is simply the present value of future earnings. Which means that if I want to know if a stock is going to go up, I want to look at if that stock can make revenues tomorrow. So let's come to Nigeria. Let's look at Dangote Cement. Forget that the name is called Dangote Cement. If a company came and said, we want to build factories in Nigeria that will make cement. Wow, that makes a lot of sense because Nigerians import a lot of cement. So if I have a company in Nigeria that is making cement in Nigeria, will they make sales? Of course they will make sales because Nigerians are always importing cement. Okay, will they make sales into the future? Of course they will make sales into the future because Nigerians will keep on buying homes into the future. Okay, will they grow market share and beat the foreign guys? Of course, because the Nigerian laws are saying that if you're a local manufacturer of cement, we will give you a better tax treatment and better import treatment than the foreigners. So if I have these three things, I'm looking at the intrinsic value of Dangote Cement 20 years ago is going to be higher 20 years in the future. So I invest. You see, I'm not giving you numbers. Don't do 10%. No, that's you trying to be too clever. Ask yourself, this company you're looking at in Nigeria today, will it be around in 10 years? will it gain market share in 10 years? Will the laws in Nigeria support this company to gain market share in 10 years? If those answers are all yes, 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 that's when you now start to look at the numbers. Okay, what's their profits? They must make a profit, right? They must sell. So you want to look at the sales return. So look at the income statement. Look at the sales. Are the sales increasing in 5 years? Over a 5-year period, are their sales increasing? If that company is going to make profit in 20 years' time, then their 5-year sales should mirror the 20-year period, right? So you want to look at their 5-year sales. Is it going up? Then from sales, you look at their cost of doing business. Is their cost of doing business going up or down? If a company starts off, it's going to have very, very high costs. But as a company now gets better in what it's doing, the cost should be going lower. Which means that, you want to look at their cost of operations. Is it going lower? Is it going higher? Then look at the gross profit. The company making operationally, are they making a profit before they pay bank loans? Are they making a profit? They should at least be making operational profits. If they're making losses operationally, but they're making their returns from loans or extraordinary items, that means in 5 years' time, it might not be a good thing. Just like if Messi was a footballer and all his goals were from penalties, would you buy him? All his goals were penalties. He's not a good striker. That means he needs penalties to score. The same way with the business. If the business is making money from borrowing money to pay salaries, we don't really like that company. We want the company to make what we call organic growth. So the products are selling. People are buying Indomie. Indomie is selling. They are making revenues. They are growing their capacity. You want to look at the story of the company, not just the numbers, the story. Is a company going to make money in 5 years? So you ask yourself, 10 years ago, was there Indomie in Nigeria as it is today? Would you have invested in Indomie 10 years ago? That's the question you want to ask yourself. So if you can answer those 3 questions, that's when you can look at the numbers. Number 1, do you think this company is going to make profit tomorrow? Number 2, will it make profit? Will the market share go up tomorrow? Number 3, will the government policies help this company? If you get 2 out of 3, it's not enough. It has to be 3 across the board. When you get this 3, you can then come back and say, okay, let's look at the balance sheet, let's look at the annual statements, things like that. So this top question you asked is a huge topic, right? We can talk for an hour, but at least these 3 questions, as a non-finance person, you can figure it out yourself and know if it's going to go up or down. Does that make sense, sir?
Yeah. Thank you. I appreciate it.
You are welcome. Let me try to get Eze Chikolo back in here, but let's get Eze, you can speak now. Go ahead. Let me go back to DM. DM folks, I love you guys.
Can you hear me?
I can hear you. Yeah.
Okay, I think the connection is quite bad. Thanks. Real quickly, I have a.
I think it's gone off again. So a good investment in Nigeria is going to be any investment that gives you what's it called? Good internet. That's going to be a good investment because every week we get this. Eze, I can't hear you. Dropped off again. Let me get the chief. The chief is trying to hook on. The chief. Let me add him. Someone is asking on Twitter Space, guys, I cannot tell you what to invest in. So if you ask me, should I buy this? Should I buy that? I can't answer that question, right? I can't give you advice. All we're doing here is educational. I can't tell you buy this or buy that. I can tell you about it. I can tell you all that, but I can't tell you to go buy this or buy that. I just can't. I'm a licensed guy, so I can't tell you without doing analysis of you. So if you're asking me, I see a lot of your question, I want to buy this, I can answer that question. So this guy is saying I have 10 million in savings, invested in money to purchase land or savings bond. These are 2 very, very, so he's asking, I have ₦1 million, I want to buy a bond or buy land. These are 2 different investment asset classes and they offer 2 different things. When you buy a bond, you are getting income. When you buy land, you are getting capital appreciation with no income. So the question is, do you want income or not? There is no good or bad investment. The investment simply has to match your objective. So you don't go and buy a car. You say why you want to buy a car, then you buy the car to suit your objective. So back to you, Mr. J. The question is this: do you want income? If you want income, you buy the savings bond. If you want capital appreciation, you buy the land. There are two different things here. So you can't compare land and savings bond. You compare your objectives. If you want to earn income, buy the savings bond. If you want to do capital appreciation, you buy the land, right? Eze, go ahead. Eze,
can you hear me now, please?
I can hear you now.
Yeah,
go ahead.
Okay, thanks. Good, great conversation. I had a question, but before I ask that question, let me just quickly share what has worked for me with credit card, both in Europe and in America. If you do this, your credit score will go up, 100% guaranteed, right? So when you get your credit card, just like Carlos said, it goes on cycles. So look at the date when your statement will be generated. So look at the date they will generate your statement. It's always there. If you log in, you go on the app, you will see it, right? Or if you don't know, ask them. Pay back your credit card 3 days to that date. It will normally show you your credit to be your statement to be generated next month, 10th of February, let's say, for instance. Whatever you've spent, pay it back on the 7th. I guarantee you the next month your credit score will shoot up. It works for me in Europe. It works for me in the US. Just to put it out there. For your children, you can add your child, even if it's 1 year old, to your credit card. Make the person authorized user build their credit score. By the time they are 18, they will be well positioned to go into the market. Carlo, let me go ahead and ask you my question. I have a whole lot of things I can suggest to people. Cashback, you can actually use. Let me
clarify a bit. Is it so? Number one, if you add your child, if the child is not, the credit cards have what we call authorized user. Let's say your child wants to travel to Europe. Americans will take their child to the bank and say, give him a credit card, my own credit card. Give the child and they add the child. Ask the bank. Some authorized users do not reflect on your credit, just to give the child emergency card because is going to school, so it might not reflect. So make sure you ask the bank, will he get the credit or is it just an additional card? So make sure you ask. It's not automatic that if you add the child, he gets the credit score. Some will say yes, if you add this child to the credit score, to your credit card, if you use the card, the child gets credit. Some will not. Make sure you find out. It's not automatic, yeah? But go ahead, your question.
The clarification is there. But building the credit score with that, paying 3 days to your statement, it works 100%. Anybody that tries it, it does work. Carlo, my question to you is, I want you to talk about the risk associated with buying commercial papers in Nigeria. And if you think it's on the high side, where else will you put your money apart from stock markets? Well, I want to hear your view on the risk associated with commercial papers in Nigeria.
So let's define what the commercial paper is, right? So if I go to the bank and I want to invest with the bank, I give the bank my money. The bank will give me what we all know as fixed deposit, right? So I'm lending money to the bank. I give money to the bank gives me a guarantee that they'll give me back. And in Nigeria, I think guarantee is 5 million, right? 5 million. So the bank gives me a guarantee that they'll pay me back. What does the bank do with my 5 million? They give it to the guy that I want to borrow money from. So there's a borrower, there's me, there's the bank. When I go to the bank, I give the bank my money. The bank guarantees me, but the bank gives my money to the ultimate borrower. So I'm sleeping happy because the bank is guaranteeing me, and NDIC guarantees the bank. I'm okay. With a commercial paper, the borrower is coming directly to me. So I've seen Dangote commercial paper, I've seen MTN commercial paper. They are saying, Kalu, borrow us the money directly. Don't go to the bank. We want to borrow the money directly from you. So I'm giving my money to Dangote or MTN or any other guy that has also got commercial paper. What's the return for me? They pay me higher than the bank. So commercial paper is just like a higher earning fixed deposit instrument. But it carries a higher risk because there's no guarantee on that, right? There's no bank guarantee. There's no NDIC. It's now an issuer guarantee, which means if Dangote says, hey, Carlo, borrow me $1 million, and now I'm borrowing money to Dangote. If MTN says, hey, Carlo, borrow money, I'm borrowing money to MTN. But there may be other guys that are not as popular as Dangote or MTN, that if you borrow them money, you are borrowing them based on the issuer name. They might pay you more, but they have no guarantee. So it's just a way of you raising your return on a fixed income instrument. That's basically what a CP is. So if you can bear that higher issuer risk, it gives you a way to earn more money on a fixed deposit. Yeah.
Okay, thank you. Yeah, makes sense. Thank you. Because what I was asking is, if you look at most of the CPs coming out, it goes from 18% up to 31%, right? So 31% can be a bit tempting, but I've sat down with a few of my friends and we've been pondering over it. Like 31%, what's the risk with it? These guys are not well known. Some of them are just starting. I don't want to name names, but it's been on the street. I'm sure some people have seen it. But what's the risk associated with going in there? If it defaults, what will be your next line of action, basically?
There's no line of action. That's the whole idea of the CP. If you lend money to someone and the guy does not pay you back, let's say to a corporate, we have what we call a corporate ladder for repayment. Usually, the creditors are lined up, right? So they will tell you are subordinated debt, which means that who do they pay first? They pay bondholders first, they pay CPs first, things like that. If you read the actual prospectus of the CP, they will tell you where you stand. So if you really want to get into the weeds of it, right, you have to go in and say, where are we on that ladder? When do we get paid? If the bank fails, this is not a bank anymore. It's now a CP, right? It's now a company. If a company fails, the law says that they pay creditors first, but according to a ladder, bondholders get paid first. Bond means that they issue the bond. I believe CPs are after bonds before they go to equity holders. So the answer is that's your only way you can go to them. You have to go, usually in America, when the bank or a company fails, there's a bankruptcy. You go to the bankruptcy court and you file that you have a claim on the assets. Then the bankruptcy court will say, okay, when we pay these guys, we'll go down the ladder and pay you. In Nigeria, I'm not sure how it's done. You can also in Nigeria sue and say you have a claim on these assets. So like if it's a debenture, you have a claim on a generator or the building that they used to issue that loan. If you don't have any claim, you might sue. You might hire a lawyer to go and grab something legally from the company because you lend them money. You want to establish they're owing you, and then you go after them. Those are going to be your options, really. But if you read the CP, you would see where it is stated where you stand. That's why you always see this word is hard for me to pronounce. Subordinated debt. You know where you stand in the graveyard or should say of that company. So if you have a lot of money there, and you really want to be really pedantic, yes, you can actually ask your lawyer to tell you where are we. If this company goes down, where do we stand in terms of the payment? Yeah.
Okay, Carlo, just quickly thank you. Actually, something new I've learned from you today is that pecking order. Who goes first after the bond? Do we have CP coming first or any other person? Yeah, that's a good insight. Now, do you think that the guys that act as vehicles when it comes to marketing this CP, do they have any role or responsibility? For instance, Dangote is not going to come out and sell his CP to people by himself. Dangote is going to go through the IBTC and other houses. Those houses, do they have any responsibility in this, or are they just simply vehicle? They're marketing on our platform, you're on your own.
Remember, if you invest in an entity, you are buying the stock of that entity or the paper of that entity. It's called issuer risk, not marketer risk. Issuer risk. So your risk is with the issuer. Of course, for marketing, for management, you can get angry with your broker, but you can't really sue your broker if the guy came to the market and sold you something he believed at that time was real, and he had no way to determine that what the company was saying was not real. So the word is issuer risk. The issuer of the instrument is who you hold the risk with. It's who you are basically beholden to, right? Not the guy that sold it to you. Of course, you see, when you have all these companies in America, they go after the issuer, they go after the bankers as well. They'll say, hey, what did you do? You sold a bond that was trash, you called it the F word, but you still sold it. That is the criminal part of the company knew that the product they were selling was bad, but they sold it to you. That's the criminal element. But usually, if it's just a normal bond that was sold to you and I sold you a bond and the company failed, you really can't come to me and say, hey, you sold me that bond. I mean, you can come to me and get angry with me, but I basically sold you that bond based on the information I got, which I believed was true from the issue of the bond. So that's how I put it. Ultimately, is the issue that you have been held here, that you are owned to, yeah.
Okay, sweet. Thank you. Great.
You're welcome.
Thanks.
Appreciate that. Yeah, appreciate that. Let's see. We've got Emmanuel here. Just logging in. Let me go back to DMs. The DM is asking, Kalu, I think we've talked about this a lot, but let me rephrase. So asking, how can I borrow? If I'm a business guy, an SME guy, what kind of bank loan should I get? Again, I've just re-emphasized. Guys, you don't want to borrow money. Hold up. You don't want to borrow money to start a business from a bank. You don't. You do equity. You do your own savings, number one. Number two, you do family and friends, number two. Number three, you do equity. There are many ways you can get financing without borrowing, right? You can do supplier finance, you can do debtor finance, you can do factoring, but you don't go to the bank to borrow money to start a business. That's going to be a guaranteed way to run down your cash and then get into trouble. Emmanuel, go ahead.
All right. Sir, I've been wondering my head about something. I work for the federal government, and I just wanted to look for a way to get a side hustle. So I wanted to use my salary account to get the loan from the bank, then pay back for my salary account, starting this Uber business whenever I'm up. I don't know if that's a good idea. And also, I want to know what time do you start this program so that I can pick a date with it each time it's about to come on.
Yeah, so last question first. We are always here 7:30 on Sundays. We used to be here by 8, but there's daylight savings time. So for now, we are doing 7:30 till we organize daylight savings time. So it's 7:30 every Sunday. I just answered your first question. I would not borrow money from a bank to start any business. And I explained why. When you borrow money from a bank, you are paying a fixed cost irrespective of what happens. There are ways you have to look for a way to get that asset without paying the fixed costs initially. It's too much for you. You are paying salary, you are paying diesel, and you're also going to pay a bank. And banks don't play. If you borrow money, you have to pay with a bank. So I would suggest you always look for a way that you can start that business without borrowing from the bank. Banks are working capital. Let's say you have a credit card now that from issued by the bank. You want to buy gas, fuel for your car to run for that day. Perfect. You can borrow from the bank, swipe your card, buy fuel, because you're going to get money back from your commuters and pay back the bank. So working capital, very, very short. But if you borrow money to buy that car or whatever, then you're paying back auto loan and all that. And it's very, very high in Nigeria. Again, I'm being specific to Nigeria. Maybe I should have clarified that. If rates were 4%, 5%, of course you can go to a bank and borrow at 4-5% for 5 years, buy an asset and go on. But they're not 4-5% in Nigeria. If you go to a bank, you work in a bank. I don't know if the bank has told you it's anywhere from 20%. So if you borrow 25%, in 4 years you've paid back the principal. Your depreciation is 4 years or 5 years on that car. So essentially, look at what I'm saying. If you buy a car with 25%, in 4 years the car is worth $0, and in 4 years you've paid the bank back the exact principal you used to buy the car. Makes no sense, bro. So if you look for another way. That's what I'll say. Look for another way to fund the car in Nigeria, especially, and the same for all SMEs. You simply can't have a business where every month you have a fixed 25% cash that must leave your business. It's not going to be, as a startup, you are paying 25% fixed. That's bank loan. Leaving your business, bank loan. And it's just the interest. So be careful about that's one sure way of crashing your business, right? One sure way. Perfect, guys. Yeah, a lot of questions. Guys, we'll spend 2 hours here. We'll start to wind down. Appreciate you guys. I'm just going to read through the DM just to make sure I've not missed anyone. I think I've answered all the main themes that we came up with. We've talked about debts, how to get out of debt. We've talked about starting your business. And we even did the mortgages. I've given you guys that link. If you go on Google, just Google my name, Kalu Aja, Naira Metrics, how to buy a house in 36 months. I gave you the step by step. Lots of things that go into this buying a house matter. Someone is asking a very great question I thought everybody would ask. Kalu, why should I buy a house? Why can't I simply rent? Great question, Brasilia. Great question. So, I said from saying that you have to live somewhere. If you live in a rented apartment, you're going to pay rent. If you live in a home that you own, you're going to pay mortgage. You have to live somewhere. And where you live has a cost. You are never going to be without a cost. So it's going to be wherever you live, do your calculation and say, because they have all these calculators abroad, and not Nigeria, where you can put in, should I rent or should I buy? If you put that in, it will tell you, yes, if you rent and if you buy, this is a number it will give you. But remember the point I'm making, because you are still going to pay. If you pay rent, there's no equity buildup. If you have a mortgage, there's equity buildup. Even if you leave the home tomorrow and you sell, at least you can keep some part of the equity because you're going to sell at the current price, but the equity is yours. You pay back the bank, you go away with the market pricing. So it does give you that. That's the first advantage you do get from that, from just having that between rent and equity. Number two, remember that if you look at wealth in America, and I'm sure wealth in Nigeria, the same thing. The wealthiest folks are the folks that always have home ownership. Caucasians what's the word now? White folks, Caucasians and all that, they have higher home ownership than, say, the minority folks. There's a reason for that. Because when you have home ownership, that's an asset, especially in the West, that you can monetize. In Nigeria, we do not have those frameworks whereby if I have a house in Surulere, I can get cash from that house. Nigerians will give you a loan, which is just not good, because if you have a loan, then you are paying back interest. But in America, I know if you have a house in Surulere, you can go to a bank. That's assuming America was Nigeria. If I have a house in Surulere or in Umuahia or in Suleja, I can go to the bank and take a line of credit on the value of the house. Not a loan, a line of credit, which means that the loan is available for me, but I don't pay interest till I use it. So imagine what that does for me. If I have a house in Umuahia, I bought the house for 1 million. The house is now worth 50 million. That means I have equity of about maybe 49 million. I can go to the bank. The bank will give me a line of credit of 20 million. I'm not paying interest though. It's just a line that is there should I need it. That loan usually is about from 10 years to 20 years, right? 10 to 20 years. So assuming I want to do business, I want to start an SME business, I can take from my line of credit and start a business. Assuming my kids want to go to school abroad, I can borrow from my line of credit and send them to school abroad. You see what point I'm making? You have that access to a long-term funding that others don't have if they don't have a home. Clearly, of course, the home is based on a loan to value, but it's still the same thing. You are going to have an asset that you can monetize. And in America, the pathway to being middle class is through home ownership. So there are many things that are for plus buying a home, and many things that are just for you paying a rent. If you're going to stay in America for 2 years, yeah, rent. That's fine. You got there for 2 years. But if you want to stay there in the West for a long period of time, why don't you buy a home? At least buy the home. You're still going to pay that rent or mortgage. Start to pay that, build up equity and then see what happens. If you have to go, sell the house. But if you're going to stay for 2 years, 3 years, you want to go to school, sure, rent. So that's the reason why I always emphasize this buying a home. I wrote an article a long time ago. I tried to share it out where I dimensioned the home ownership in America to demographics. I think I wrote it during the Juneteenth. I think I wrote it there, where we're talking about if you really want to make minorities in America have economic power, you've got to go back and change how they can buy homes. I tell you what, if you Google redlining, most of you know what redlining is. Back then when we had when blacks were not like economically active, and when we had the racism, before we had civil rights, you could not buy a home. Let's say you were in Lagos. They would say if you are black, you could not buy a home in certain areas of Lagos. You couldn't buy a home in Ikeja, in Lekki, in VI. They would redlining. So you could not buy a home if you are black in certain neighborhoods in America. Why do you think they did that? Because if they keep you all in one area and it's a black area, the house will not appreciate in value. Even if it does, it's just there, right? But if you can come to quote-unquote Asokoro and buy a house as a black person, then you have entered the economic ladder in America. It's automatic for you. So even the white racist folks back then, not everyone, the racist folks back then understood the power of mortgages. That if you want to keep a minority class down, you prevent them from buying a mortgage. It's called redlining. So look at it this way. Someone is saying that I will not give you this thing because if I give it to you, it will be good for you. Now you can get that thing and you don't want to get it. That doesn't make any sense, does it? Right? They didn't believe that blacks owning homes would be good, there will be no redlining. Right now in America, it is illegal. It's illegal to even think about doing that. Say if someone is black, you say, I'm not going to give you a loan, or you can't buy a loan here. You can get into a lot of trouble if you do that. Because when you buy a home, especially in the West, it's your pathway to being middle class. Right? That's basically it. And it's the same in America and Canada, in Europe. It's your pathway to middle class. It's the safest, slowest way to get to the middle class. Because you buy a home, just by inflation, the home value is going to keep on going up. Just by inflation. But your costs are fixed, right? So that's the hack. You have a 30-year mortgage that is fixed, but the home value is going up. So that's just a hack for you. So you don't sleep on that. All right, so we'll talk about credit cards. Not a lot of credit cards in Nigeria, but I know there are one or two. If you're able to get them, do get them. The credit cards in Nigeria are mostly for the upper income folks in Nigeria. I wish we would have credit cards that are going to be more for the lower income folks in Nigeria. So the students can get a credit card and they can at least use it, put the $50,000 naira limit on a credit card for a student. They'll pay it back because they do jobs. Most of them have a job, but they really get into a lot of trouble sometimes. They have nothing to eat. So responsible credit usage, teaching that to our students when they're very, very young, giving them access to capital through that might be a good way to start off. Not 20% interest rate, but very, very low. So that we learn how to use credit. Credit is a force multiplier. It's not bad. It's just a force multiplier. The chef in Abuja. Sorry about that. Just saw your hands. Chef, you've got the floor.
All right. Okay. Good evening. Thank you so much for everything you've said this evening. So I just want to say something. So I'm new to when it comes to investing, and I've been following your podcast recently, for the past 2 weeks now. So about the debt, credit card stuff in Nigeria, I think most of these things you've said is not really applicable to us here in Nigeria. So as a young guy who is just starting life and all, there's a lot of investment, there's a lot of stocks, shares, mutual fund, and a lot of things happening right now in Nigeria. And so there was one of your podcasts, you said something about mutual fund, and one of the speakers said something that when you're not sure of what you want to go into for the meantime, you can just put your money in a mutual fund while waiting to explore the stock and the shares. So, sorry, I just want to say something briefly. I saw something on one of these fintech apps. I don't want to mention the brand. So they were advertising stock and bond. And I saw, a lot of people recently are hyping some of the Nigerian stock on this fintech app, like some oil company. And I saw some company performing better than even some of these popular oil company, like a palm oil company is doing better. And I'm like, okay, so I was actually thinking, buying Nigerian stock aside this popular stock, buying those other brands that are not popular, like these companies that produce palm oil, that their stocks are doing very well. Is it advisable to buy such or to put one money into such?
So I can't answer that question. Like I said, I can't tell you what to do, right? I can't tell you to go buy this or buy that. All we're doing here is educational. So, but see, I've always given you, there's a step-by-step process you have to take before you invest. Step-by-step process. You can't just wait. You just can't start to invest. You have to have a plan. Like if you are driving from here to Kaduna, you have to check your tires. You have to put gas in the car. Then you drive. You just can't wake up, get into your car, and drive. So the very, very first thing you have to do, is you want to ask yourself, why are you investing? That's easy for you. Why am I investing for long term? Am I investing to save my rent money so I can have more money to pay next year? Those questions determine how you should invest. So you have to know why you are investing. Are you a long term, short term, risky? What's your risk profile? Get that one. Understand why you are an investor and the type of investor you are. That's the first thing you want to do. Then, like I said, before you even invest one kobo, you want to build an emergency fund. What's an emergency fund? It's going to be 3 to 6 months of your necessary expenditures, what we call your non-discretionary expenditures, which means that what are your non-discretionaries? Things that you must do or spend money on, even if you have no money. Like what? Number 1, food. Number 2, medical. Number 3, rent. You have to pay these things even if you don't have any money. So if your total non-discretionary expenses come to about 5,000, at least have 5,000 in an account, near cash, before you invest. I would say have 15,000, but if you want to have 5,000 to start with, okay, but you must have emergency fund before you invest a kobo. You must have that before you invest a kobo. What's the next thing? Insurance. Especially if you are married or you have a dependent. You can't invest until you have insurance. What's insurance? There's nothing like life insurance. There's insurance from loss of income. So if you have a wife or you have kids, you want to go buy life insurance before you start to invest. Very important. Because when it happens to you, then of course those guys or the insurance companies will pay, and that can take care of your dependents you've left behind. So let's say you've got your emergency fund and you have dependents. If you don't have dependents, you don't need life insurance. What are they going to pay to? So you just have your emergency fund, life insurance, then you can then say you want to invest. Now, if you want to invest, I like top-down investing, which means I go top and I say, what's top? The earth is top. What's next? The continents. There's North America, South America, Asia, Africa. Do you want to invest in Africa? If you say you want to invest in Africa, okay, what country in Africa? Let's say Nigeria. Okay, Nigeria. What sector in Nigeria? You start from the sector. Why am I going this way? Because I don't have the money to buy the individual company stocks. Nigeria has about, rough figure, about 300 listed securities. America has more than 5,000. So how can you choose which ones are good, right? But if you buy the fund, Either you buy the mutual fund, unit trust, or the ETF that is tracking the index. Then you've bought everything Nigeria, right? So if you buy that one, you've now bought Nigeria. Then inside that Nigeria, you can ask, okay, what sector should I even focus on? Should I buy food? Okay, which company in food? There's Bua, there's Okumo, there's this. Then you now start to go individual, but you are coming top down. Nigeria, food, then which particular food company as your income increases. Because if you take your income and you want to chart to buy individual stock, you're going to buy a lot, you won't buy enough, so you're going to spread your bet so thin that even if you make 100% on 1 naira is 2 naira. 100% on 1 naira is 2 naira. But 10% on a million is 1 million, 1.1 million. Look at it that way. 2 naira and 100,000. It's the same percentage, but look at it that way. So you want to take those steps first, right? And most importantly, you've got to really study before you invest. Don't like I hear you saying, people are saying this, people are saying that. What do you say? Like, go on YouTube, put that company in there to give you lots of information about the company. Tell you lot this stuff you're listening today. You are picking up a few stuff. Excellent. You're learning how to invest. You're learning a few words. Keep on doing that. You've got to understand investing before you put a kobo down. This is the point I'm making, right? Don't invest without knowing, understanding why you're putting money away. If you do that way, it's going to work out for you, right? But you've got to know why you're investing before you invest. So you can't say, should I buy this or should I buy that? Does it meet your objectives? That should be the word for you. Is it going to pay you dividends? Will the share price rise 100% tomorrow? That's what you want to ask. And you know that from knowing your objective. If your objective is to make income, if you are older, that's your objective. If your objective is to grow because you are younger, good. You want to find out those companies that you want to buy in that. Not sure if I helped you, sir. Did I help out a bit?
Yes, thank you so much. Thank you so much, sir.
Mm-hmm.
Yeah.
Appreciate you, sir. I really appreciate you guys. All right, guys, 2 hours and 30 minutes. I think we're going to call it a day unless anyone has any last thing to say. DM, guys. I appreciate you guys. I've searched through. I'm looking for any unique question there. Most of you are asking the same questions. I appreciate the questions, but I think we've answered most of them. This one is good. This one's asking about pension. Although your question is not what you're asking, let me rephrase your question. It's asking about, I don't have any savings. I saved through my PFA. Is that enough? Yes. Good question. So most folks in Nigeria do not have any savings apart from what's ordered by the government. So most folks have this retirement savings account that's where they save their money, retirement savings account. That is a very, very good way to invest. Why? Number one, your investments are growing tax-free. Tax-free, which means if you put a naira in that account, the government will not collect taxes on that 1 naira till you take it out. So it's growing tax-free, it's compounded, number two. So you always hear compound returns, compounded. This is a compounded savings account. Your RSA is a compounded savings tax-deferred account. You can't get that anywhere. There is no other investment in Nigeria that is compounded, deferred, and tax-free. I think maybe insurance, but insurance doesn't take money from you every month. Okay, it does. So let's see what's the difference between insurance and your RSA. Insurance growth is not, I don't know if the income growth is tax deferred. I think it is. But with the RSA, you can invest little amounts. It's based off your salary. Yeah, that's the difference. With insurance, you are the one paying. With your RSA, you pay, your company is paying. So if you do RSA, your company is paying, is it 10% of your basic housing transport? If you do if you do insurance, you are the one paying. But it's a tax deferred, compounded savings account. You can't get it anywhere in Nigeria. These three things. So you put money into your RSA and you save, and it's good for you. The question is now asking that, is this enough? I think the answer is no, it's not enough. Because when you invest in an RSA, remember, you are just investing your basic housing and your transport. You have to do a calculation. If you go to a good financial advisor or to a banker, you ask him, I want to retire in X amount of years. I want to have X amount of money when I retire. how much should I save? He will give you an answer. It's just called present value calculation. He will take out his calculator, he will press some buttons, he will do a few assumptions, he will give you an answer. It's called present value of an annuity. He can, if he can't do it, he should be able to do that for you. A banker, a stockbroker, the present value of an annuity. So what you then want is you now come back and you compare. You say, today I am saving 10,000 naira every month in my RSA. But when I do my calculation, I should be saving 50,000 naira every month in my RSA. So what you do an additional voluntary contribution, because when you do that calculation, if you want to save to get 50 million naira in 10 years, if you do a present value back to today, it might translate to you paying 50,000 naira today. You do that calculation, you do an additional voluntary contribution, you save in your RSA. Yes, you can do your RSA, you can mirror your RSA and save somewhere else, but you want to increase your investment. Your most important savings is your retirement account, not your kids' schooling account, not your mortgage. Your most important investment account, it's your mortgage, it's your retirement account. Why? As you get older, you can no longer work. So you have a limited time to make money. It doesn't matter if you have a brain that is functional. You can't work. You're going to get older. So because you're going to get older, everybody here has a terminal time that will work, which means we only have a fixed amount of time we can save, earn, and invest. Everybody here, we're going to have a fixed time that we can save, earn, and invest. So if we know that to be true, then we want to make sure that we are maximizing that time. Remember, you have to first of all earn the money. Then you have to save the money. Then you have to invest the money, all in the same time period. We have maybe 25, 50 years. Let's say we have 50 years. You have to earn the money in that 50 years. Sometimes you're going to earn the money, but you don't save it. So it's gone away to the wind. So you've got to earn that money, then save that money, then invest that money for those 50 years. Some of us start when we're at 0, some start at 10, some start at 45. But you must do all these 3. If you don't do all these 3, you'll be destitute. I'm just saying, because you will have no money when you are at retirement. So you have to earn, save, invest, and the time is fixed. You can't increase how long you're going to live yet. So if you know this, your most important investment is your retirement account. That's it, your retirement account. Before you train your kids, before you pay for your house, you pay yourself first by saving into your retirement savings account, so you are there and not a burden on anyone when you get older. If you're in America, there are lots of things you have to do. Long-term savings, because there, when you get older, they put you in an old people's home. But if you have money, you can pay for someone to come to your house and take care of you. So you have to start to save for long-term care. Very important. It's not medical care. This is long-term care. So you're in your house. Someone is coming to your house to take care of you. Your kids might not be there. Your kids might travel, might not be there. So this is in America, you did. When in Nigeria, we don't worry about long-term care because we have community. We have welfare. If you're in your village, somebody will take care of you. In America, we just jackpot to America. All this jackpot that people are going to get to 60, 70, your kids are not going to be at home. Who will take care of you? If you are married, fantastic. But what if you're not married? Or what if both of you are old? You need to have long-term care. So you pay for that one. So that means you have to save in your health savings account to pay for that long-term care. This American I'm talking to, right? Nigerians is different matter entirely. Nigerians will do welfare if you are old. Yeah. But if you're American, start to think of yourself in 60, 70 years and say, where would you be at when you're old? How would you fund your retirement? Very, very important conversation. You do it very, very dispassionately. You go to a guy, he'll give you numbers, you start to save. So that's your most important savings account. Don't sleep on it. Don't sleep on it. If you don't have an IRA, if you're an American, you don't have an IRA, you don't have an individual retirement account, you should be deported. What the heck are you doing there in America without an individual retirement account? What are you doing? And we have the same version of IRAs in Canada, and I believe also in the UK. All it means is that you have an account, individual, that you can save towards your retirement, your individual retirement account. It is so good that the US government will restrict you from how much you can put into your IRA. So they won't let you put more than 7,000. When the government is saying we won't let you save, you know it's good. You know it's good. So you want to save. There are rules about IRAs. You can't save if you earn a lot and all that kind of stuff. But overall, you should be saving in your company 401k plan. If you work for a company, find out from them, what is my match? What is the match? If the match is 3%, please save minimum 3%. Minimum. Then open up an IRA. I like Roth. Google this thing I'm saying. ROTH. IRA. Google them. Save there. Nigeria, we don't have Roth. We don't have IRA. But we have retirement savings account. You must make sure. Don't say government is bad. Government is corrupt. That story. Save in your retirement savings account, because no other account in Nigeria gives you tax deferred. So you're not going to pay tax on the growth of that investment. You're not going to pay tax on the growth of that investment. Compounded returns, which means that if you put a naira today, they pay you interest of 10 kobo. Next year, they invest 1 naira 10 kobo on your behalf. You don't have to do anything. It's compounded tax deferred. Insurance does it. I think NHIS does it. But this is your RSA, so you want to do it as well, right? Very, very important. All right, folks. I've got Cosmos Exchange. What's up? Thanks for hopping there. Yeah, Cosmos, what's happening?
Okay, good evening, Mr. Kano.
Hey, what's up, man?
I'm so happy to be in your space. I'm following you since 2022. Yeah, and there is one person again, Mr. Toib, is in UK, and also I love your program with Olumide. I'm following you people because the value you people are giving to the community is so numerous. I'm so happy. So it's just a compliment. I'm so opportune you accepted my mark today since 2022. I'm so happy today, sir. The value is encouraging. Also, I'm also investing in the stock exchange using Bamboo, and having some knowledge and what you are giving out, both S&P 500 and a lot of tech companies. They over the years they have given a good return. So I'm so happy with the knowledge and information you are sharing with Olumide and everyone in the speakers section. It's so encouraging. Thanks, and remain blessed. Thank you.
Appreciate you, sir. Thank you for thanking me. I appreciate you so much. Now, guys, I don't want to be very, very modest, right? The job I do, people come. Listen, I'm telling you, they pay me. I tell them. So I'm doing this really for Nigerians. So if you notice my space, it's you guys, So please don't take it for granted because I'm giving it to you for free and I'm answering questions for free. This stuff, I learn this stuff and I'm giving it to you. It's not for free. People pay and I give it to you. So please don't take it for granted. I'm not trying to be, I talk like this cold because I want you to learn it, right? So please, what I say is best practice. Plan your retirement. Earn, save, invest. This is just best practice, right? You've got to invest. You don't want to be a burden. The world is changing. When we grew up, we took care of our parents. When you grow up, your kids might not be there for you. Your retirement plan is no longer your kids. You've got to plan yourself, right? If you live in a big house, you've got to ask yourself, it's 5 rooms. Your kids, you built that house because your kids are going to be there. Your kids are not going to come back and live in that house. They won't. They have their own plans. So start to ask yourself, how can we monetize that big house in GRA? Where can we go to live? Things like that. So start to do it now, because in 20 years' time, there's going to be a huge demographic shift, not just in America, also in Nigeria. Many things we don't do in Nigeria today, you will start to see them in 20 years' time. You're going to see old people's homes are going to spring up in Nigeria. Old people's homes. Lots of folks that are in America, in Canada, in the UK, will want to come back to Nigeria when they are 70, when they are 80. They want to come back. They will. And they need to a place that is safe, that they have all those facilities that they enjoy in the UK, but want to live in Nigeria. So if you're an entrepreneur, you live outside Lagos, you can literally start to build estates targeted at the returning Jackpot people. It's going to start to happen pretty soon. going to start to happen. Even right now, lots of people that live in America want to come back, but they don't want to come back because it's not safe. They don't have a nurse and all that. But imagine if you had an estate where how much is a nurse? Don't mean to be rude, but how much does a nurse earn in Nigeria? So you have an estate where you have each home has a nurse. Then the estate has got a doctor on site, has a hospital on site, has old people's gym on site, has security, has a wall, you have mopo there or whatever there. And then you have chalets, you have organic food, you have entertainment. The same thing we have in America where you have those old people's homes, but you have in Nigeria. Do you know you can charge each home, you can charge those homes, each home there in dollars, $5,000. People will pay to come back home to Nigeria and live there. And it doesn't have to be in Lagos or in any built-up area. You can do it in those. It even makes more value in those towns because they're coming back to go back to the quote-unquote rural life. So you say insecurity. If you have a compact with the town people and you say, listen, we're going to bring in these people into this place, no kidnapping, no whatever, but you're going to get a share of the revenues. People will come. In Ecuador uses the US dollar. Lots of Americans go to Ecuador and retire in Ecuador. They just live there because it's lower cost of living. Because if you earn Social Security in America, it's $2,000. In America, it's nothing. In Ecuador, in Costa Rica, in Mexico, it's a lot of money. The average Social Security benefit is going to be about $3,000 a month. So if you live in America, the government, when you retire, will pay you $3,000. This is just on Social Security alone. Why would I live here if I have to pay rent at $1,000 a month? $1,000 a month is how much in Naira? If you build a flat, even if it's a flat, and you put old people there that want to come back to Nigeria, and you protect them, they have medical care, they're eating the all those traditional food, you take them with bus every week to go out. The same thing you do here. People will pay. And you make a lot of money, and that town will make a lot of revenues from just this influx. The same way people are living in Nigeria, go to Jakarta, it's going to be the exact same thing you're going to see. Lots of folks want to come back, but they're not going to come back because it's not safe. There's no medical care, there's no 911, there's no all that stuff. So you create a little village somewhere in Abeokuta, somewhere off Umuahia, somewhere off Nasarawa. People will come back because they want to come back there, they want to live there. You already seen the Jackpot, you already seen the Dirty December, but you have 11 months. The same way those guys come back for December because they want to enjoy a Nigeria life. It's the same way the guys that have retired want to come back to Nigeria and live here and move around. They just want to come because it's not safe and there's no Medicare. You have a hospital in Nigeria, you say, okay, we're going to use this hospital as Medicare approved or Medicaid approved or whatever. If you go to that hospital, you can share a medical records under HIPAA with a hospital in America. Things like that. You've got to get innovative and creative. There are lots of Americans that work in America, that work in lots of Nigerians in America that can help you pass these laws. Texas, Atlanta, then Boku, they don't want to stay there. They want to come back home. But you've got to have a plan. And if you can't do it alone, talk to your state government. That's remittances. They will pay this money directly to the state government for a safe place they can go to that is fantastic to live in. The weather is beautiful. They can live here, take their palm wine and their Panadium. That's what needs to happen. So that demographics is going to create opportunities in Nigeria going forward. And if Nigeria is not ready, they will go to Ghana and Togo and live in Ghana and Togo. At least they're in West Africa. So don't assume that it must happen. So that's a good business plan for anyone that's interested. You've got to go and plan. There are folks over there. Get in touch with them. Get a branded name. Get all this medical stuff. Put it together. People will come. It's dollars waiting for you right there. Dollar inflow. But you are spending in Naira. It's not the reversal. They will pay you in dollars, but all the cost you are giving them is in Naira. The nurse is paid in Naira. Rent is in Naira. But you are earning dollars. In your village, they don't want to live in Lagos. They want to live in your village because that's what they're coming back for. But it has to be safe. They've got to have medical care. They've got to have quality of life. If you do that, you are on something. All right, folks, let's call it thanks for hanging out with me all through. We've got about 2 hours and 45 minutes already, and I thank you guys for doing that. Let's go make a good year. Don't forget to get the book. I wrote the book, right? Let's Talk About Your Money. Great book, lots of pictures. Everything we're talking about on this space is in that book. Everything: credit, debt, investing, crypto, mortgages, real estate, planning out your target savings plans, education. Everything is there. Even love and money, how to talk about money when you are dating, married, and all that. So it's a great book to have to read. It's not chapter to chapter. It's not cover to cover. It's chapter by chapter, which means you can read just stock market and understand it. You have to read the whole book. But it's a good book to reference from. It's written with a Nigerian mindset. So I try to use most of the international things that we do, but make it Nigerian so you can also follow. So I will say get it. It's available on Amazon. Anywhere you are, just Amazon. In Nigeria, it's on Roving Heights. But Amazon is going to be your best bet to get that book. Right, folks. On that note, I'll let you. CDS, did you have a follow up, or is your hand up for COS? Did you have a follow up?
Sorry, what's the name of the book? What's the name of the book?
Let's Talk About Your Money. It's right there on my DP. Let's Talk About Your Money. You see it right there, pinned tweet. Yeah, Let's Talk About Your Money. All right. Folks.
Okay, thank you.
You're welcome.
Okay, thank you. What I want to know about the book. Yeah, I've seen it in your pinned post.
Excellent.
Yeah.
All right, perfect. Yeah. All right, folks, have a good one. It was nice hanging out with you guys. We'll be here again same time next Sunday, 7:30 p.m. West African time. You guys have a great day. Thank you so much, and bye.